So there are three people, all also colleagues of Ray's at Wonderful that have yet to join us, but that's one reason why I'm recording it. All right, so I'm Nick Katko from BMA. You know, I focus on lean accounting, and one of the issues that has been part of lean accounting really for the 30 years I've been involved in it has been standard costing. And really that's sort of one of the reasons how lean accounting got started, because there were people like me and Jerry Solomon and others who were working, and you know, we were working in lean companies, and we realized sort of more just intuitively that standard costing wasn't working very well for the lean company. And so it's sort of like, let's go down the lean accounting path, even though like we didn't really call it lean accounting. We just did what was sort of logical and deal with standard costing. And so one of the reasons I like to run this course is to give everyone an idea of what the problems and issues are, and, you know, sort of solutions also. This is very interactive. Okay, I don't want this to be like a webinar where all I do is talk. And I really want all of you to drive what we talk about, how long we talk about it. The agenda is very adaptable. Let me go over it with you. Hold on one second. I'm trying to. So, you know, we have three 90-minute sessions today. This is the general outline of the agenda. It may adjust depending on how much time you want to spend on particular topics. But I want to give you an overview of the problems. And we're going to look at, you know, one of the, it's sort of like how is standard costing used in companies, and compare and contrast. So one thing is performance measurement. That is a use of standard costing information. So what I'm going to do is sort of show you how, through a couple examples, how it really doesn't work and how it can lead to poor decision making. And then we'll talk about lean performance measurements. The capacity piece right now in the presentation is actually in section 2. So if we have time, we'll move it up. But one of the numbers of lean accounting is understanding capacity. Okay, how much, you know, what are we spending our time on? Are we spending our time on productive activities to serve our customers? Are we spending, how much time are we spending on waste or non-productive activities? How much capacity are we creating due to improvement? And this is really I call this one of the new numbers in lean accounting. And you know, standard costing does not consider capacity. But when you see how capacity is calculated, you can see how it can be very, very useful in analysis and decision making. Then we're going to look at measuring and analyzing profitability, which is another use of standard costing. Typically, it's, you know, what's the standard margin for the month for the company? What's the margin of a particular product? Things like that. We're going to talk about the value stream income statement and how that is a superior tool than standard costing. And then we'll talk about making decisions and how we make decisions with what we call the lean accounting box score, and how that really leads to improving the quality of decision making. And then the third session, we're going to get into more of sort of we're going to go behind the curtain almost, And, how do you sort of make the first two sessions are about the numbers and analysis and decision making. Third session, how do we eliminate the waste in standard setting? How can we simplify standard setting? How can we reduce the number of reporting transactions? And then how can we do lean inventory evaluation? So this is sort of a roadmap to begin to simplify standard costing. And at some point, hopefully in your lean and lean accounting transitions, you can go to a lean inventory valuation. And as we say in the lean accounting community, turn off standard costing. And so this is very much a journey. Okay. What I like to say to, okay, Peter's coming in. What I like to explain to people that have a standard costing system in a lean company, that this is something you're going to have to deal with. Okay, I mean, because standard costing was designed for traditional mass production manufacturing, and it works well for that. But when you become lean and you start looking at operations differently, standard costing doesn't really deliver the right information at the right time. And so it can create a conflict. Okay, over the years, I've had more than one like operations leader from a company call me up and say, we need some help because we're getting all this information that we don't need, and it's coming out of the standard costing system. We don't know what to do. Okay. Peter, are you there? He was there. Peter, can you hear us? Okay. You can unmute, Peter. And I encourage you to keep your mics unmuted, because as we go through, if you have a question, please just say, Nick, I have a question. Okay, you don't have to do the chat stuff because we have a small group here, and then we'll talk about all of your questions and topics as much as we want. Okay. All right. One thing I noticed, and we can decide this at the end of session one, there's an hour break between session one and session two. There's a half-hour break between session two and session three. If by some chance you want to reduce that hour break to maybe 30 minutes and then move up session two and session three and finish 30 minutes earlier, we can do that, but I'll leave that up to you, and we can talk about that in about an hour or so. Okay, just keep that in mind. All right, so let's get started about the problems. If you think about a standard costing system, it's deeply embedded in a company. It has it almost has like a lot of tentacles. It can be used for performance measurement purposes. That's the idea of absorption, variances, things like that. It can be used for analyzing profitability. I already mentioned that a few minutes ago. What's the margin? I mean, everybody wants to know what's that gross margin, which is based on a standard cost. And how profitable is this product? How profitable is this product line? Things like that. Production reporting in your ERP system. Okay, the level of detail that is required that is configured in the standard costing system at one level can drive the level of transaction reporting out on the floor. And then if you think about standard setting and inventory valuation, okay, you know, accounting and finance, you have to go through this process of setting standards every year. And again, that's a level of how much detail do you need, or how much detail do you have to set every year? And that's really a function of the idea of creating an accurate product cost. Okay. That the more that's sort of the thinking, that we need an accurate product cost, that usually drives a great level of detail in standard setting and then correspondingly production reporting. And it's primarily to analyze the profitability. All right, here's somebody else. Bianca is joining us. Peter, can you hear us? You there?
Yeah, I'm here.
Okay.
Good morning.
All right. And then finally, you know, just the role of accounting, you know, the sort of the maintenance of the standard costing system, how it's being used, the level of detail, the amount of analysis that has to be done, you know, really drives roles and responsibilities in accounting. I will say, you know, and I'll refer back to this a lot, in my first CFO job in the 1990s at a company called Bullard, we went on a lean transformation. It was, I always like to say I learned lean the right way, because we did everything you're supposed to do and we saw the results rather quickly. I dealt with standard costing there. I ended up turning it off. Well, you know, not just by myself, but we as a company agreed that it was the best thing to do, because we realized it wasn't serving our needs. And just, you know, the quick story, what did it mean to us turning it off? We set our labor and overhead rates to 0. We kept material cost in the system. And so, you know, we'd still see inventory numbers, but it was just material. And what it ended up doing for us was it eliminated a lot of variances. It eliminated the absorption numbers, and people could rely on the inventory numbers. We never had those discussions about why does product A more than product B and stuff like that, which are very annoying discussions to have because it's all about the assumptions that are made.
So I have a question. This is the one thing that challenges me in the environment I'm in right now, because we have some commodity products that do not take very much labor and overhead, and we have some more specialized products that take a lot more proportionate to their total cost in our standard costing environment, a lot more labor and overhead. So if we can't, how do you understand the cost differential between those products? And I think it's important for us to understand, if only for pricing and decisions and things like that, to understand our costs more than a flat percentage across all products.
Yeah, actually, that was the topic of yesterday's webinar. lean pricing. No, that's okay. We can talk about it. Here's the thing.
I signed up to the wrong webinars.
No, that's okay. That's okay. We can talk about this. I can bring up some slides later on if there's an interest in this. You know, the labor and overhead that goes to one product versus another is basically driven by the amount of time it takes to produce.
Mm-hmm.
Okay, because you have a labor rate, you multiply that by the time that it takes to produce that's in the system, you get a labor cost. then you multiply that labor cost by the overhead rate, you get the overhead rate.
Mhm.
So automatically, you know, the longer it takes to produce, the more it's going to look like it costs. What that does is that sort of then drives this decision making. Oh, well, if people think it costs more. So, and if you're using that cost to set a price, which is dangerous, first of all,
I know.
you know, it's like you're trying, it's not, you're trying to achieve a certain margin. The question really becomes, what's the price the customer's willing to pay? Okay. And, you know, price and cost are not related. But when it comes, you know, that's one piece of it. See, there's many layers to all this. Another layer is understanding costs. Okay. And we'll talk about this a little bit later. Your labor cost is fixed. Direct labor makes your labor cost appear to be variable. But your labor is fixed. Okay. You know, you pay the people the same amount. Okay. Doesn't matter what they produce. And so when it comes to analyzing costs, you know, this is where like value stream income statements come into play. But it's really about, you know, I'm going to just put all this up. It's really about sort of taking all this apart piece by piece, okay, and dealing with standard costing in sort of a rational way. Because, for example, if sales and marketing uses the standard cost to set prices, you know, you can't just sort of pull the rug out from under them and say, we're not going to do that anymore. They're going to go, whoa, no, you know. So you have to introduce them to different ways and let them learn the new ways. Then it's a whole lot easier to take it away. Make sense? Okay. Anybody have any other questions? Comments at this time?
Yeah, I'd say that we have this similar kind of issues here, so it would be interesting to see the slides you were referencing, because our white wines stay in cellar much shorter than our red. So we allocate overhead, and I hate the allocations, but that's,
Yeah.
what we do, so.
Yeah. So whites are less expensive than reds.
Right, but when someone asks me a question, I spend a good 3 or 4 hours digging through Excel models, trying to figure out why
Oh, yeah.
something
Yeah.
was 3 years ago more expensive, because we have that factor too, where we buy grapes 2 or 3 years ago that go into
Yeah.
products that we're selling now. So,
All right. Well, I made a point on the pricing and quoting. And we can talk, let's see how things go. Again, like towards the end of this session, you know, we can look at the agenda and we can make adjustments. Okay. I mean, like I said, I want you to drive this. I want you to get out I want you to get what you want out of this. So we can talk about pricing and quoting. I can talk about it for a little while. And then you can access the recorded webinar to listen to the full hour if you want. Okay. All right. Great. So anyway, let's talk about performance measurement. And like I said, you know, I don't have a lot of slides where I'm talking. A lot of it is going to be exercises and things like that. So anyway, here's our first group discussion. Okay. I'm going to put up some traditional measures. And what I want you to do, and again, this is all just verbal, you know, tell me what behavior the measure drives. Okay. So purchase price variance. What behavior does it drive?
I mean, I'm constantly trying to dig through those transactions to figure out what's even going on.
Right. But if you wanted to have a favorable purchase price variance, okay, because, you know, you want the variance to be favorable, not unfavorable. So you want to try to drive favorable purchase price variance. What behavior do you have? What has to be in the supply chain? What do you have to do?
Increase the standard.
I'm sorry, I didn't hear you. Capri.
So only increase the standard, right? Increase the price, right? Standard which we are booking against,
Yeah,
right? So
yeah. But if I'm a company and I call you and I'm a supplier and you're a supplier and I say to you, hey, I want to get a better price.
We purchase more than we need
yeah, so
to
that's
get the
right.
it.
unit rate. Yeah.
Right, yeah, I'll give you a better price, buy a whole lot.
Yeah, we have like 10 years of inventory on something right now that we're not even gonna use, so.
Yeah, we have an issue with steel and coils coming in. Right now we have a blanket PO open. And because of our lot size, it'll say our system will tell us that we need 3 coils. When really we probably only need 2, maybe only 1, because the lot size is incorrect. And then our suppliers will drop off 8. So yeah. And with the
But-
CRU indexes going up and down, it's a significant problem.
So, but what's the lean behavior that we want to drive from a lean thinking viewpoint when it comes to inventory?
Just order what
Just-
you need.
Yeah, just in time.
That's what I'm saying.
Just in
Mhm.
time.
So-
yeah.
Yeah, so you can see if purchase price variance is a performance measurement, it conflicts with trying to buy just in time. And what you do is you're putting people in a position where, you're saying, oh, no, we're going to be, we're just going to buy what we need. We don't want excess inventory, but that's one statement. The other statement, though, is, we're evaluating you on the purchase price variance. So it's a conflict. So how about overhead absorption?
So quick question on that.
Yeah,
We
yeah.
have a production plan that is constantly changing. So we can order packaging and then 2 months later, it's not valid anymore and we have too
Yeah.
much. So, I mean, how do you solve that? I mean, fix your production plan?
Well, that's where, that was Cindy, that was you. Who was talking there?
Yeah, it was me.
Well, this is where, this is more sort of lean and lean accounting. If you let systems tell you what to buy, there's a lot of slack built in on that. Okay. And they look at history, they look at a forecast, the best way to put in a real-time purchasing system is a Kanban system where you set inventory levels, and when it reaches a certain level, it sends a signal to purchasing to buy a certain amount. And that controls the purchasing. And if you let MRP control purchasing, you're going to have a whole lot of inventory.
The only issue is like, we have vintage specific things. So if we buy like 2020 labels, we can't use them for the 2021.
Right. Well,
So,
yeah. Yeah. And those are sort of problems that you solve through continuous improvement. What's the impact of that? How can we get better at it? I mean, I know apparently there's always a guess, about how many labels you have to buy, but you sort of have to look at, understand the purchasing and procurement process. Somebody else want to add anything? How about overhead absorption? What behavior does that drive?
Building inventory.
Yeah, overproduction and building inventory. Okay, if you want to have favorable overhead absorption, build more inventory. And that's in non-lean plants, that's a favorite tactic at month end to make profit look better. Okay, and I actually, at the company I worked in the 1990s, the director of manufacturing that was there when I got there, he was a master at playing that absorption game, but it finally got caught up for, I don't want to tell you the story about how it sort of came to the surface. And, it was just like, no, this is not good behavior. So again, you want to be make to order, okay? That's, you just want to meet the actual orders, meet the actual demand. And so that's why if you measure any part of the company on overhead absorption, but you want to be make to order, there's another conflict.
Nick, this is Gurpreet Rai, right? I have another question
Yeah,
for this, because the question is this, because now scenario is changing, right? Because we are a global company and we have to ship to Asia. And logistics is taking like 3 to 6 months. So if we are building to the orders, it's going to be challenge for us now. So we have to build ahead now.
yes.
How you see that in standard accounting?
Well, having to build ahead lean is, lean says make to order. And ideally you want to just, meet the exact demand. But the fact of the matter is, for like seasonality purposes, your capacity in your high season may not be large enough to meet demand, so you build ahead a little bit. That's a logical thing to do, but it's driven more by understanding capacity and capabilities. It's not driven by the overhead absorption number. And so same issue, I think, for you, if you have to build ahead because you're shipping around the world and it takes a while, because of supply chain issues today, again, you're doing that for serving your customers, not simply because of overhead absorption. Now it's going to over absorb, but it's not really overproduction because of the reasons why you're doing it. Does that make sense? How about production? Oh, go ahead.
Can I ask a question about that?
Yeah,
From a
yeah.
practical standpoint and monthly P&L results in a cyclical environment, when you're building ahead, you have more labor costs than you would need for what you're shipping that month, but you need it because you're building ahead. So how do you manage the P&L impact of that?
Yeah, good question. I guess the simplest answer is you have to, this is where sort of lean accounting box scores come into play. People need to look at the real numbers. That whole over absorption is it's about, how much inventory you're building and how much you're selling. And it's really about costing the products and valuing inventory. And so it's beyond the control of operations. Okay. So you really have to have sort of if you have things like the box score in place, then you're saying, okay, this is how operations performed according to the lean practices we have in place. So let's evaluate that. The financial reporting statements, yeah, we overabsorbed or underabsorbed, and people need to understand why. That it's a inventory valuation exercise. But you don't want to hold operations accountable to that. Because, they're going to say, we built the orders we were told to build. And we shipped what we were told to ship, things like that. So production variances drive what kind of behavior? You want favorable production variances. Long batch sizes, long production runs, or large batch sizes, long production runs. Okay, the more that you stop production, you know, you have the chance of creating an unfavorable variance. And again, we want to flow in small batch sizes. Okay, that's conflict between measurement and behavior. And then when you're looking at product costing, what kind of behavior does that drive? When it comes to profitability, it can lead to poor decisions. And we're gonna, throughout today, we're gonna look at some of these. I mean, I said this yesterday in the webinar, and we'll talk about it later. If you're using a standard cost to set a price, you have a pretty good chance of either overpricing or underpricing compared to what the market will bear or what the customer wants. I mean, I worked at one company, and this is an exercise I'll show you. They had a company rule that if any product has a standard margin of less than 30%, it should be outsourced. That was the company policy. And so what happens when you start outsourcing your products? What happens to the other products you keep?
They get more expensive.
They get more expensive. So what do you end up doing?
It's kind of a death spiral, right?
Is the death spiral, yes. Okay. So let's open up your Excel file of exercises. Go to exercise 1. I'm going to put it up on the screen and I'm going to explain what to do. And it's a pretty simple exercise, okay? All right, I'm going to minimize the screen. So, and by the way, most of these exercises, most of them are based on real case studies that we've done or that we worked on in companies. So here we have a process. There's drilling on the CNC machine that takes a minute. They work in a batch size of 2,500. It goes to lathing, takes 4 minutes. Goes to grind, takes 6 minutes. Goes to inspect and pack, takes 4 minutes. Hold on. Matthew is joining us. So you can see the current operating performance, 6-week lead time, 25 days of inventory, batch size, 2,500, on-time delivery. So what I'd like you to do here, over here on the left, is calculate the standard cost of the product. So you put in the material cost, calculate the labor cost based on $20 per hour. The overhead rate is automatically going to calculate, and it'll calculate it'll sum and give you the standard cost. That's question 1. Question 2 is, how many units can this value stream produce in 1 hour? So go ahead and I'll give you a few minutes to work this out. Exercise 1 has three parts to it. So this is part 1. Hi, Matthew. How you doing?
Very good. How are you?
All right, we're on exercise 1 in the Excel workbook. Exercise 1A, I'm sorry. You know, if you want in the chat box, when you're finished, just put that you're finished. That way I can get an idea.
Yeah,
All the information needed is right there on the screen. There's no tricks to this exercise. Anybody need any more time?
Hey, Nick, I have a question. The 10 days regarding the batch size of 2,500 in the graph, what does the 10 days refer to?
All right, you want to see the answers? You guys ready for the answers?
Yeah,
All right, there we go. So the material cost $1.50 a unit. The labor cost is $20 per hour divided by 60 minutes times 15 minutes, or $5 an hour. The overhead cost is $5 per hour multiplied by 300%, $21.50. Anybody have any questions about the standard cost? All right, did anybody get a different answer than number of 10 units per hour?
I thought it was only 4.
Okay. And so you took the
Just
15
the
minutes?
straight time.
Yeah. Okay, no, that's fine. Anybody else get a different answer?
I think I assumed it was the same person doing all.
Okay,
Which would,
actually,
I mean,
that's-
that's really not.
that's
I
okay.
realize the fallacy of my assumption at this
No,
point.
that's okay. That's okay. This you're not in school or getting graded. But yeah, there's actually one person in each of these a different person in each of these operations, 4 people.
So you
Alright,
take the longest one, right?
yes. So why did anybody yes, explain that? Because this is really, really important when it for exercises 1B and 1C.
That's kind of your bottleneck. I mean, the most you can do is the one that takes the longest.
Yes. The bottleneck, or it's also known as the pacemaker or the constraint. The process step that has the longest cycle time, in this case, it's grind, 6 minutes, that controls the rate of flow for the entire value stream. You can't make more than 10 per hour unless you find a way to change the cycle time of grind. But standard costing is just looking at the total time. Okay. So now let's go to exercise 1B. Okay. So some improvement, one major improvement has been made. You can see up here on the a drilling machine, a small drilling machine has replaced the large CNC machine. And it has quicker changeover. It can produce in smaller batch sizes. It takes a little bit longer to run, 4 minutes compared to, I think, 1 minute. Everything else pretty much stays the same in terms of production time. But because of this drilling machine, they were able to create flow, serve customers better. Now we have a lead time of 2 days, inventory of 5, batch size of 1 day, on-time delivery. We've improved operating performance. Customer likes all this. So what happens to the cost of the product in this, after this change is made?
So I'm struggling with this change because we've introduced a machine and it takes longer, but it's a smaller batch. Is that
Yeah.
the difference?
Yeah, I'll go back to exercise 1A. You know, this CNC machine worked in a batch size of 2,500 units at a time, and it only took 1 minute. So again, you have a batch size of 2,500 flowing through here, but that's not the order size. Okay? And so
Okay.
everything's getting clogged up because of all the work in process inventory. In here, they were able to basically get more to make to order. Okay, you have a large CNC machine. It's a very expensive machine. It's a large investment. You know, the rationalization is we have to use it because we paid for it. And it also had a longer changeover time. So anybody need any more time to do this, or you want to see the answers?
Okay.
Here's the answers. The product cost goes up to $25.50. Why does that happen? It now takes 18 minutes to produce, takes longer to produce, and your labor is going to be driven, your direct labor is going to be driven by the total time. And that also means the overhead is going to be higher. Did the actual cost change? We still have 4 people working there. Did the actual labor change in the value stream as a whole? No, it didn't. You know, so, you know, if you were just looking at this from a product cost perspective, you'd probably say, no, this improvement was not successful. The other thing is that you can still make 10 units an hour because the bottleneck has not changed. So in essence, what the improvement is, you know, you're slowing down the drilling process and you're trying to make it as close as possible to the bottleneck time. That creates flow. Everybody understand that from a lean operational viewpoint?
Yep.
Any questions? Anybody get anything different here? You guys got quiet on me.
I'm taking notes, sorry.
I'm sorry, what?
I'm taking notes, sorry.
No, that's okay. I just,
You know, I mean, if I think about it, if this is all we did, the cost isn't any different in either scenario in terms of labor costs.
correct. You are absolutely correct.
And the only difference would be other cost differences, whether it's the depreciation on one machine versus the other, right? If you were
Yeah.
looking at that. But neither one of them is really costing the product right. Because
Yes,
all the areas that take less than 6 months, if those people are standing around for 2 minutes because of the constraint area, the cost is the same.
yes, you are correct. Right. And, you know, in lean operational thinking, you know, you don't want a person or a machine to be running at maximum utilization if you're overproducing. You just want to, you know, produce to exact demand. So yeah, great observation. Anybody else have any observations or comments? Because we're going to do exercise 1C next. All right. So exercise 1C, if you look at the very simple value stream map, another improvement is made, and grinding, they were able to reduce the cycle time in grinding down to 4 minutes from 6 minutes. Everything else remains the same. So again, you know, what's the new product cost? Would you consider the improvement successful, just from a product cost viewpoint? Question 3, how many units per hour now can this cell produce? Then the bonus question, question 4, you know, if 40 more units per day can be sold, like 5 per hour over 8 hours, what's the actual profit of those 40 units if the sales price is $40 per unit? And all the information you need is right there on the screen. So number 4 is the bonus question. All right, I will put the answers up. So because we're reducing the total time by 2 minutes, the product cost is less than exercise 1B, but it's still greater than 1A. So if you were just comparing exercise 1A to 1C, you'd still say the product or the improvement was not successful. Did everybody get 15 units per hour as the production?
Yes.
All right, and so those additional 5 units per hour, what is the profit on those 5 units? Or profit per unit? It's the sales less the material cost of $1.50. So the actual profit is for 5 units is or the actual increase per day is $1,540. It's the contribution margin. Does everybody understand that?
Yep.
This is sort of the financial leverage of lean, in the fact that you create more capacity by reducing this cycle time. You keep your costs the same, and you can get more out, and the incremental profit is a whole lot more, because the only cost that changes is the variable cost of the material. So any questions about exercise this one? And what's your reaction to this exercise? What's going through your head?
There's different steps that you have to take to get to your final step.
Okay, yeah.
Your bottlenecks are killing you, basically.
Yeah. Yeah, well, and every process has a bottleneck. That's part of lean thinking, is that you want to understand where your bottlenecks are. And at one level, you try to focus a lot of your improvements on your bottleneck, because the more that you improve the bottleneck, the more that you can really increase output.
I mean, when I look at this, I would have applied the standard cost to those additional units. But when we think about lean, that overhead's already been absorbed, right? So it just,
Yeah, I guess the best way to think about it is that the actual costs are fixed.
right.
The people, the labor, 4 people, fixed. Most of the other costs are going to be considered fixed. They're not going to vary in direct proportion with 1 unit sold. The only cost which really varies that way is material.
Or that's a whole different, like, that's a brain shift.
Oh, it's a big brain shift. Yes, it is. That's
But how would you come up with these the overhead rate?
well, okay, this is just in the example. I
Right.
mean, when you're calculating an overhead rate, what you do, okay, you're really challenging me to go back 35 years, but I would, because I don't really try to teach this anymore. What you do is you use your budget or whatever numbers you use when you're setting your rates. And you would say, what are the costs which we're considering overhead?
Right.
So let's say we're using an annual budget,
Mhm.
we gather all those costs. And then we say, okay, what is the budgeted direct labor dollars that we have? And you simply divide the direct labor dollars
Right.
budget into the overhead budget, and you get this percentage.
Right.
Now, go ahead.
I use a history. So
Yeah.
when we do it here, we look at basically 11 months of history to set our overhead rates for the next year. And it's just that mathematical computation of, direct labor
Yeah.
to the overhead. And we use direct labor hours
Okay.
based on standard hours, not
Yeah.
actual hours instead to do our percentages, but.
Right. So ours is a little more complicated because I have 3 years of overhead going into one.
Yeah.
So I was just trying to conceptualize
And-
an easier way to
and-
do this, but
and-
that's still standard cost, right? And we need
It's
to,
still standard cost. Yeah. And the other thing you can do, you could break this down. You could do one overhead rate for the company. You could do one overhead rate for a site, or you can break it down by like departments.
we do it by program.
Okay, you could,
so-
yeah, there, you could break it, you could have lots of different
Item,
overhead rates.
Yeah.
About 12, 15 years ago, we did work at Boeing for a few years in their commercial aircraft division, and they had 2,000 labor rates and 5,500 overhead rates.
We don't have quite that many,
No,
but
I know.
we do
no,
have a lot.
Yeah, but
we
they
need to
were, oh
simplify
my
it.
gosh, they actually narrowed it down too. So anyway,
So my question related to this is, assuming that direct labor's fixed is not really a reality for us because we do flex labor as much as 30% month to month, depending on the cycle of our year.
so is that with like temporaries?
Mhm.
Yeah, that's fine. But yeah, I mean, but again, that's a management decision. Bring them in, and we did that at Bullard. We had the base.
I guess, yeah, it's for us is, so AP, codes when it's coded, it codes and identifies the project.
Who was talking there? I couldn't hear you. Was that? Yeah, yeah, we had our base full-time employees. We had temporary pool. And they were flex, but the other thing about the temporary pool was, we were training them in case a full-time employee left, or we had to hire more people, you just pull them out of the temp pool.
Right.
Yeah, and no, that's just smart business, and a lot of lean companies do that. But, you could consider that does vary a little bit more with demand, but not necessarily on selling one more unit, So that's how you sort of think about like fixed and variable cost is if there's a direct relationship, make one more, make one less, what costs change? Those are the variable costs. Everything else is fixed. Because it will vary, but it's not going to be based on just that direct change in volume. And it's really important, I think, for people in companies to all have the same thinking about those costs. Because that's where you start getting into decisions.
Mhm.
Okay. I'm going to go back to the presentation. And so we talked about, we have about 15 minutes left. We talked about the weaknesses of using standard costing in terms of measuring. So how should you be measuring improvement? All right, so you have to think about lean performance measurements in terms of sort of reporting cycles and purposes, okay? And so this is just a general checklist. So first of all, you have daily measures. And these are at the cell or the process level, okay? And really, you're trying to meet certain performance standards. I'm going to give you some examples here in a couple minutes. And they're really about the cell or the process team being able to understand, how did we do today? And every day is a new day. They're used in the daily huddle to reveal problems and issues. Typically, you only have like 3 to 5 measurements. What they end up driving are simple just do it improvements that the team can work on. The shift in thinking about lean performance measurements is that they are designed, or their purpose is to reveal problems and performance problems and issues. Okay, they're not just report numbers that are being reported, and you're measuring the process. So then, and you can call these cell measures, you can call these daily measures, and just like the next level of measures would be weekly or value stream measures, where you're looking at the value stream performance as a whole. And you're trying to measure improvement. Are we improving on-time delivery? Are we improving productivity? These are used by value stream teams in weekly meetings to evaluate performance, overall operating performance of the value stream, and the effectiveness of all the improvement events that are going on. Then at the monthly level, and this could be at the company level, the division level, or the business unit level, you have monthly measures where, like, the leaders are assessing the overall success or the overall impact of a lean strategy. So how many of you have measures like these in place? Or some form like this?
Somewhat.
I'm sorry?
Somewhat. We have a Gemba walk for a daily huddle.
Okay,
We do have a weekly meeting. I think that it should be more or less in the conference room versus out on the shop floor.
Okay.
So that's something that will be suggested from my end. And then monthly meeting, we definitely don't do, but we do a quarterly meeting.
okay. And there's variations on this. This is sort of like, sort of the standard, and you have to take sort of the basics, and then how do they apply in your company? Anybody
Right.
else? Let me put the measures up too. These are the categories of measurement: delivery, quality, lead time, productivity, cost, safety, morale. And what you really want to do is have those categories of performance being measured. And sometimes one measure can measure more than one of these categories. And the beauty of lean performance measurements is that you can't exploit one and not, if you try to exploit one by using non-lean practices, it typically makes another one look bad. So here's a list of basic lean performance measurements. I'll let you take a look at these. And so like at the daily level, schedule attainment is, what was the plan? How many, for example, if it was on a shop floor, how many units were we supposed to produce? Did we produce that amount? Yes or no? A lot of daily measures are sort of what's called discrete measures. It's a yes or a no, changes every day. You measure quality. What's the defect rate? What's the first time through rate? And sometimes schedule attainment, this is where it really measures delivery and productivity, because, a cell has a certain plan for the day, or any process says, what should we get done today? Did we get it done or not? If we did, we've delivered and we were productive. If you are in manufacturing, you also can look at the material flow. So this would be the actual WIP to the planned WIP. Now, a lot of times this is not necessarily counting, but it could be a visual measure based on Kanbans, things like that. If you're looking at cost at a daily level, you're looking at what are the drivers of cost. Okay, you can't really, you can control the drivers, you can't really control the cost. So for example, if overtime is an issue, you would be wanting to look at, understand what are the causes of overtime at the daily level in a particular cell. Why are we working overtime? Because that's going to reveal the problems and issues which can be resolved. And then there's lead time. Again, and these are just examples, change over time. And then incident rate, cross-training, safety, morale. When you get to the weekly measures and the monthly measures, they are more continuous in nature, meaning we're trying to improve them over time. We have a measure of productivity, sales per hours worked or sales per person, okay? At the weekly level, we measure defects, quality, the overall quality. It's difficult to measure quality at the company level, okay, because the number doesn't mean anything. Some companies use cost of quality, okay, but cost of quality doesn't tell you anything. You can't drive into root cause analysis. The best place for understanding the causes of quality problems is at the daily level, because it's easier to identify the root causes. And then you have on-time delivery, days of inventory, which can be used both at the value stream level and the monthly level. When you're measuring cost, because most costs are fixed, cost is a cost, or costs as a percentage of sales is a pretty good measurement, because in a lean company, you're going to grow the revenue over time. And if continuous improvement will create the capacity and keep your costs growing at a lower rate than this revenue growth. You can also measure lead time, and then there's the safety and morale. So how many of you have measures like these in place, or, partially or totally?
We have some.
We have some too.
I think we have some here, but I don't think that it is visible enough to make it up to senior management, because they ask me all sorts of questions all the time. But I think that production is tracking, so I think we need to start making them visible.
Yeah. And, we call this like the starter set, okay?
Right,
So
I know
these
it.
are-
At WPNA, we had FMBS boards, so you could walk around and see anything anywhere.
Yeah.
And I think that could be a good start for us.
And so we don't, I had an exercise here where, you know, you could figure this out on your own. What would be good basic performance measures for your company and then report out. But given the fact that we only have a few minutes left till the bottom of the hour, this would be like a good exercise for you to do on your own, okay? You know, here's basic lean performance measurements. Here's the categories of the measurements. What, you know, you sort of do a like an assessment. Which measures do we have in place? Where do we have some gaps? Okay, and sort of try to rationalize the measurements so you get back to something like this, you know, daily measures. Now, like you mentioned that WPA, which is, by the way, that's wonderful pistachios and almonds for those of you who don't work there. You know, a lot of times in lean operations, they'll put in what sometimes they call SQDC boards, safety, quality, delivery, cost boards, where they're putting in some basic lean measures in place. Okay. And what we talk about in lean accounting is you really want to do the same thing at the value stream level. Have a value stream board with measurements, but there you're looking more long-term and you're trying to understand root causes. And you could even have monthly measures. I mean, I live in Lexington, Kentucky, and I did some work a few years ago at a local software company, helping them on their lean transformation. And we put the performance measurements in place. Then what they decided to do, and this was on their own, they took the conference room and they actually painted some of the conference room walls, and they were able to put all the performance measurements for all three value streams and the company all in one room. And we did a monthly report out. And so what everybody did is they just stood up at their part of the board and talked about their measurements.
So
Yeah.
I have a question on, back to the slide before.
That one?
Yes, in the, like the productivity measure where sales per hours worked or sales per person sounds really good until we experienced last year and we have like 30% price inflation on our sales number because we have, you know, double and triple raw material costs. And
Yeah.
well, how do you adjust for that?
Well, for example, you could use units. Okay, there's variations on these measures. And you know, when I work with a company on developing a lean performance measurement system, what we do is you sort of have to take you know, what's a productivity measure? Okay, you understand the basics. It's output over like input. Okay, so sales, that's output. What's the value added output? What's the input? Okay, hours worked or people. Now, if you have issues with product mix, or like you said, prices, you know, and you don't want, and you don't want sort of the measure to give you like a positive false or a false positive, meaning, you know, it looks like we're really, really productive, but the only reason we're productive was we raised our prices. So you make the adjustment. You know, let's just look at units. Okay, a unit's a unit. If we're selling more units and if we're getting more units out and we're not increasing the hours worked as much, that's productivity. Anybody else have any questions? So, you know, just to wrap up on performance measurements is you're creating a system. Okay, and some of you may have some of these in place. I know that just from experience in like it wonderful that you probably have a lot of this in place. You have your basic performance measurements. They're displayed visually on boards. They're used in daily and weekly meetings, and the purpose is to solve problems. So it's a system. It's not just reporting the numbers. And this is sort of one of the foundations that, you know, when you put the performance measurement system in place, you now rely on that. You don't rely on things like variances and absorption. Now, the variances and the absorption may still be, the system may still be producing those numbers, but basically you got to ignore them. And you got to drive everybody's attention to lean operating performance. So you start the lean performance measurement system, stop the variance, stop using the variances and the absorption to analyze operations. You know, teams own their measurements. There's an opportunity here to also reduce transaction reporting and rate setting. And like I said, ignore the variances and the absorptions internally. And a lean performance measurement system is really sort of both, it's accounting, it's operations, it's leaders of the company coming together to understand how to build the system, how it's used, who uses it, what's its purpose. And then from there, like I said, you know, using standard costing information for performance measurement goes away. All right. Anybody have any
I have a quick question.
Yes.
So being in the steel industry with the market being so volatile right now, and the steel going up and down, what's your take on that as far as looking at the variances with that, with the lean accounting? Is it just going to flow down onto our financial statements, or we're just going to be recognizing huge gains and losses dependent on what the steel prices are?
Well, you know, there's, when we, in session 3, when we talk about setting standards and stuff, you know, like one of the, you know, you set a material standard. Now you can create, and typically in ERP systems, you have a choice. You can use the standard that you set.
Mhm.
You could use like average, let the system calculate what the average is, or you can use last price paid as the standard. And,
Right.
and so sometimes it's just looking, it's just making that change in the ERP system that helps deal with the variances, you know. But yeah, I worked with a company in 2021 that used steel, and they were getting involved in quote, they were really involved in quoting and pricing and things like that. And they had the same issue that you described.
Yep.
And so you sort of, you know, yes, we're living in sort of unprecedented times and all that stuff. But, you know, I think people still need to understand, why is this variance being created? And the variance is not real. Does it impact financials? Yes.
Mhm.
But you sort of have to understand, you know, how are there ways to mitigate the variance, either in standard setting, or sometimes it's also in the reporting piece. Okay.
Right.
All right.
We,
So
Stephanie,
go ahead.
Stephanie,
Lori.
we make steel fence, so I am living in your world too.
Yep.
And we may want to at some point connect and just
Absolutely.
discuss some things, because when I actually went to your company's website and I was like, that could be pictures of our plant out here. It's so
Yep.
it's so much the same. We buy coil steel and we make steel fence. So
Mhm.
if at some point you want to collaborate or talk about
Yeah.
some of those struggles, because I've been living it too.
Absolutely.
Yeah, you don't have that with grapes or pistachios, right?
I
our
think I'd
own
rather be
problems.
doing the wine. than the
I
Yeah,
mean-
that sounds way more interesting.
Well, what you can
Glasses.
do, if you did have problems, you just drink the wine, right?
Right, we could just go out and take some inventory.
I mean, our raw material prices are all over the place too, especially
I know.
glass.
I
So,
know.
Oh.
Okay, so, okay, it's time for our first break, and like I said, it's scheduled for 1 hour. You can have the full hour if you want. We can do 30 minutes and then finish 30 minutes earlier this afternoon. What would you like to do? You want to vote on it? Doesn't matter to me.
I don't care either. I'm fine with either.
I say 30 minutes.
I will go with Cindy to 30 minutes.
Bye-bye.
I
Okay,
could do 30 minutes, but
all right, okay,
I might be eating when we come back.
that's okay, that's all right, it's okay. All right, 30-minute break, come back at the top of the hour. We'll talk about profitability, decision-making. If we're gonna talk about pricing and quoting, this would be a good time to talk about it. I'll give you the options before we get started, okay? At the top of the hour. Okay, I'm gonna pause the recording and I'll see you in about 30 minutes. Okay? Who's on the? Okay, everybody ready to look at the answers?
Yep.
Okay,
Nick.
all right, so. Let me zoom out a little bit so you can see. Can you still see that, read those numbers?
Yes, Nick.
Okay. So the actual the actual expenses, that was just pasting those numbers over. Okay, where you get 1,702, I'm sorry, 1.7 million, 1.702 million for period one, 1.726 million. Did everybody get that?
Nick, I got it, but I think whenever I put in total manufacturing expenses, right, I think the formula is wrong, right? We are missing the row 9. So it's
Materials?
no, yeah, it's missing the material cost in my spreadsheet. It should be, formula should be from H9 to H19.
You can just change the formula or move what you pasted down a row. I had the same problem.
Oh, okay. There weren't enough spaces?
The formula on line 20 is not including
Oh,
line 9. So you
Okay.
can't paste onto line 9. You have to paste onto line 10.
okay. Oh, well, Excel. So this number, sorry about that. So you paste those numbers over. Then the inventory adjustments. You paste these numbers over. And then what you have to do is you have to take this standard cost of goods sold right here and put that down here. Nope. Sorry, paste value. Hold on, I didn't do it right. You put the cost of goods sold at standard, then you back off, then you put all the variances in there and you create the net change in inventory. Oh, you have to put the I forgot to put the SG&A in. And then if you put the SG&A in, you should be there. Everybody see that?
Yes, Nick.
Yeah, so it's, you know, this is a very simple exercise. That the point of the exercise is that, you know, you can take your conventional and you can convert it. You know, the real key, if you're using standard costing to value inventory and if it's valuing cost of goods sold, you know, you have to take these numbers here, however they're shown in your financial statements, and you have to bring them down into this inventory adjustment. What you're doing here is you're lumping the absorption, the standard cost of goods sold, and all the variances into one change in inventory number. Anybody have any questions or comments? Think this would be difficult to do in your company?
The part I struggle with is it seems like we're comparing apples and oranges on the revenue line and the material cost line, just simply looking at those two lines. Because the cost of the material that we sold was 1,134,000.
Yeah,
And it just feels like, I don't know what a good actual margin percentage would be under this method.
yeah, well, this is excellent point because, you know, this is about the way numbers drive the way people think. And yes, everybody's very comfortable seeing this cost of goods sold number, even if it is at standard. They know that historically, you know, whatever. Let me just do this real fast. you know, people are comfortable with this 19 or 18% margin. Okay, that's, you know, how it is historically. And then when you come down here, you know, is that good? Is 15%, 16% good or bad? And you know, but you know, there's a, what you're trying to do here is, like I said, establish the cause-effect relationships between lean operating performance and financial performance. And you're also trying to find ways to drive better margin, but it's different. Okay. It's mostly about creating flow, because if you can create flow, and if you can use improvement, you can create flow and you can sell more, you're going to drive the revenue. Okay. And like we showed in one of the examples earlier, you know, most of these, the material costs will change. It's variable, but most of these costs are not going to change because they're more fixed in nature and not variable. So it's about improving. How do we improve this number? Now, I will say it does take time getting used to. Now, if you look at it, that's why I typically recommend to companies just do statements for each value stream first before you get to the company level, and try to create one complete value stream format income statement at the company level. Because if you're using value stream box scores and you're looking at the specific operating profit of a value stream, you develop those relationships, cause-effect relationships. They get to be understood, and they even get to be understood by sort of leaders. Then when you present, it's a little, a company income statement is a little bit easier to understand. So again, you know, I've worked with some companies, they do just value stream income statements. They don't create a company-wide income statement. Then there's other companies that do that. So you have to sort of take the tool, which is a value stream income statement, understand how best to apply it in your business for effective decision-making. Okay?
Nick, I have another question now,
Sure.
because we are doing the value streams here, right? Because I want to improve every week, right?
Yeah.
Like my challenge is coming up, right? Like even the labor I can get from the clocks. I know how many people clocked in that area, and I can easily figure out the labor costs. How about the material and other costs, right? Like everything else, because people are not buying weekly basis. It's coming like even we are getting from our GL, and we are getting the invoices like service happened, but I'm getting the invoice 30 days later.
Yeah.
But still it's not directly involved with the like value stream like that week, right? So even I'm talking about those expenses about 30 days late, 60 days late. How that challenge, like how you see in other companies, like how they are doing that kind of stuff. Like because if I want to see this is happening with this activities, this is happening with this activities. So how I can relate those things all together.
Right. Yeah, good question. What I recommend, you know, the people, like you said, you can identify the specific people, get that through payroll. Material is a sort of separate category, but all your other expenses should be just what is being reported. Use accrual-based accounting. Okay, we're not suggesting that you try to create cash-based income statements when you're accrual-based, but whatever is getting posted through, you know, the accounts payable, just report those numbers. Okay. I mean, you know, that's the easiest way to do it. We don't want to make this way too complex where people don't understand the source of the numbers, or accounting has to do a tremendous amount of extra work just to produce these, okay?
Got you. No, that's absolutely, I'm doing it, but the challenge is like, there's the people here and they want to see the bottom line, right? Like how much money they're making. They're the profit driven guys, right? So they don't want to talk about anything else. They all just want to see like how much money I'm making. That's their decision making. I know, I totally agree with that one.
Yeah,
But they are like, their personality is like that. They want to just see the bottom line. They want to see, did they do the good week or they don't have bad week. But then all of a sudden those costs are like, there's a 1 week, like all the costs comes in, right? So they look bad. Then they all start questioning the same way, right? Like, hey, what's even, it makes sense to them, right? So they are like, how, I thought maybe there's a way you think, like how you guys are doing it. So I can make streamline that too, right? So,
yeah. Well, I think, you know, the users of value stream income statements, first, they need to be involved in the development of the income of it, okay? Because they're the ones who end up being the customers. The other thing is that it's important for everyone to understand the purpose. I mean, you know, there's the reported profit and there's sort of improving financial performance. And if you can improve financial performance using value stream income statements, your reported profit is going to get better. So you got to really present the complete box score. Okay, if you present just value stream income statement by itself, people can't make any connections. But when they can make connections between a value stream income statement and performance measures and capacity, and they can see the impact of improvement, for example, okay, now it's now their mind changes. So
I'm not aware of anything.
it is a learning process. Okay. And, you know, it might take more time with some people than other people. Anybody else have any, questions, comments on value stream income statements?
I don't think so.
Okay. So let's move on to capacity. Now, this is going to be, hold on 1 second before I share. Let me look at my Excel file and make sure I guide you. So you'll use for the capacity exercise, which is exercise 4, and for the decision-making exercise, which is exercise 5, you're going to use the tab that says EXS 4 and 5 decision-making, okay? And so have that one open. What I'm going to do is I'm going to put numbers on, I'm going to display numbers and really display where you enter the numbers. Okay, for understanding capacity. So let me get back to sharing my screen. I will say this, for those of you who attended the Central Coast Lean Workshop a couple weeks ago, it is great having help when you're doing an online course. When you have to do it all, there's a whole lot that has to be done. All right. So let me get to capacity. Okay. So capacity is, there's methods which companies measure capacity, and most of it is in traditional ways. You know, how many man hours do we have? How many machine hours do we have? Things like that. But from a lean thinking and lean accounting point of view, we're looking at it differently. Okay. We want to understand how much productive capacity we have, which is how much time are we spending on value-added activities? Basically, just, for example, producing the product. How much time are we spending on non-productive activities such as waste time or non-value added but necessary activities? And how much time are we creating due to continuous improvement? That's the idea of available capacity. Because if you think about continuous improvement, if you're doing an improvement event and you eliminate waste, what are you typically creating? What do you get out of it? If you eliminate or reduce a wasteful activity, what's the immediate benefit?
Time.
More time, right? Now, time, does it show up on the financial statements anywhere? No. Okay. It's sort of a number. Now, people that have experience with continuous improvements, they intuitively know this. But I don't know if you've worked at any companies, but a lot of companies that I've worked with, especially like larger companies, they sort of have corporate policies that every improvement event needs to show a cost savings. Okay, but if you're just creating time, you're not necessarily saving any cost. Especially if it's related to activities people do, because the salaries are fixed. So this is what the capacity numbers do. All right, so again, I'm gonna put the slides up. I'm gonna explain what we're doing, drop the numbers in. I'll show you the answer. This I found is the best way for people to learn how to understand capacity rather than through just theoretical examples. All right, so the first step, and capacity is typically calculated over like an average month. You can calculate capacity in a value stream based on the resource that does the work. Do the people do the work, or do the machines do the work? Okay. So again, this is simple. You can do, you could do capacity for every step in a production process. You can just do it for the bottleneck process, but we don't have time to get into all that. I really just want you to see the numbers. So total employee time. Okay. So we have 15 people. So you can drop that number in, number of people. 20 working days in the month. They work an 8-hour shift. There's one shift. And then the lunch and break time is 60 minutes. So if you drop those numbers in, did everybody get 126,000 minutes? So that's the average time over the course of a month. Now what we want to do is we want to break it down between productive and non-productive. So we have to look at, what are those activities that go on? Okay. So step 2, productive time. So if you go down to these lines in the Excel spreadsheet, we have 4,875 units that are shipped. And there's a 10-minute cycle time. That's how long it takes to make one product. So drop those numbers in. And you should get 39%. So 39% of the 126,000 minutes is being used on productive time. Anybody at this point have any questions? All right, so now what we're doing, we're going to do the non-productive time. So that, you go to this part of the spreadsheet. What I always, when I'm sort of doing training on capacity with companies, I like to tell them that what we're really doing here is quantifying the waste. So the waste has been identified and we're quantifying it in the common denominator of time. So, excuse me, for example, if you go to changeover time, we have a batch size of 500, so drop that number in to that cell. Changeover time of 60 minutes. We don't have any overproduction. In the scrap and rework percentage cell, put in 20%. For inspection, put in 30% for the percentage of items inspected, and an inspection time of 10 minutes. And then there's downtime of 20%. So those are the numbers that you should see on your spreadsheet. If anybody got any different numbers, let me know. So see, okay, how much time do we spend on, does this value stream spend on changeover? 731. How much time did they spend on scrap and rework? Well, over 12,000. How much time on inspection? 18,000. Downtime, 25,000. So just looking at these numbers, if you were going to look for opportunities for improvement, where's going to be your biggest return on effort for improvement events? What are you going to try to improve? Or what would you try to focus on?
Eliminate time, that's a 20%.
Yeah. Yeah,
That's
yeah, improving quality. And you think about it, there's sort of like a multiplier effect of improving quality. If you improve quality, maybe you can then reduce the inspection percentage
Mhm.
and downtime. Are you really gonna, at this point, are you gonna focus on changeover time? I mean, how much can you gain? Can't gain that much. So this is one of the other benefits of calculating capacity, because it can help, sorry, guide teams as to what they should focus on. Okay, next step. So that was sort of the unnecessary wasteful activities. Now let's look, we have some productive but necessary activities and time we want to account for. So this would be 5S and huddle times, okay? So we have 15 people. That number should be in your spreadsheet already from entering it earlier. If it's not, let me know. So we spend 15 minutes a day on 5S, or 15 minutes per person per day on 5S. So drop that number in. And then there's 15 minutes in the daily huddle. This company also wants to account for continuous improvement time, which on average is 8 hours per person per month. So drop that in that cell. Now, these are non-productive from a lean viewpoint. These are non-productive activities, but they're necessary, okay? You want your team to do 5S every day for orderly workplace. You want, you know, the daily huddles are an important part of the overall lean operating system, and obviously spending time on continuous improvement, you know, it takes away from spending time on productive activities, but it is beneficial. But so we want to measure it. So these are what the numbers look like. "45 minutes each on 5S time and huddle time. Total non-productive 52%. And then 7,200 hours or 6% on continuous improvement time. And then if you subtract the productive and the non-productive and the continuous improvement from 100%, you get 4% available capacity. So that's how you calculate capacity. And it's how the numbers are developed. So I just wanted to stop here. Questions, comments, discussion. What do you think about this?
This is good, Nick. So this is the stuff we should be working on daily basis. But the still is like, so they're the accountant, right? Like as a finance guy, this is the problem production people should be solving, or this is the problem we should be solving for that?
Oh, good question. Typically, okay, so let me back up. I forgot to say something about capacity is something that is calculated periodically. Okay, it's not, you don't want to do time tracking. You don't want to be updating it on a daily basis. If you think about this, you have a current, you know, capacity. This is sort of like the average for a month. So what's the current state? That's what we're calculating here. When improvements are made, you can update capacity. Okay, and then you're going to see in the decision-making exercise, which we're going to do next, how you can use this to understand the impact of certain things on capacity. Typically, what I say, you know, you could see if you were trying to calculate this on a daily basis, somebody's going to be a spreadsheet jockey, but there's no value in that. Typically, the development of the capacity, I like to say, developing the numbers or developing this spreadsheet is a cross-functional activity between operations and finance. But then you really want to sort of have, for every value stream, you want someone to be the spreadsheet capacity master. So they maintain the actual spreadsheet. You want them to update it. Now, you know, copies can be sent out, but there's only one master copy. Now, typically, I would say you want someone who has a good understanding of lean and, you know, what the waste and wasteful activities and things like that to be the master. So that could be a lean person. It could be someone in accounting if they have that experience and knowledge. Any other comments, questions, discussions on capacity? Think this would be beneficial to be used?
Yeah, absolutely.
Hold on one second. I have a. you know, you have to, again, these are new numbers. People have to get used to them. But when you know, this is one thing that standard costing doesn't do. Standard costing, when you're looking at the cost of a product, it's really, it really assumes full utilization. It assumes you don't have capacity. Okay. And so, like, if you're looking at some kind of decision, and you would say, okay, you know, what are the additional costs? Well, just take the standard cost and multiply it by the number of units, and that's how much our costs are going to change. Even some companies, they'll say, oh yeah, we'll take the material and the labor. We won't take the overhead. We'll say this is how much our costs change. But you know, if you're creating capacity, if you can measure how much capacity you are creating, then you can go back to that value stream income statement and say, well, no, these costs are not changing because we have the capacity, which leads us into the next exercise. You ready for that, or you want to talk more about capacity? Okay, so here's the scenario, and here's what I want you to do. So manage the expectation. Right now, the monthly units shipped 4,875. Based on sales forecasts, you know, the monthly demand is going to go up to 6,000 units per month beginning in the next quarter. Okay. So that's one thing we have to understand, is what's the impact on capacity. Management would also like the available capacity to be 10% and not 4%. 4% really is a little bit too low. Typically, you want like between 10 to 20% available capacity, because if things go wrong, problems and issues occur, you know, if you don't have any available capacity, then you're going to have bigger problems. So on that spreadsheet, in the opportunity column, in rows 11 and 16, type in 1125. Okay. Then I'm gonna switch over to the spreadsheet and explain what to do. So you type in the 1125 here in 13, and if you scroll down beyond the capacity, you're going to see a little value stream income statement. Okay. And that should be populated in the current state. Is yours populated now?
Yes.
Okay. All right, so it should look like this. Okay, you have 6,000 units here. And if you scroll down, is this what you see? Negative 11% capacity. Everybody have that?
Yes, Nick.
Okay, so this is where you are now. So I'm gonna, and there's many ways to go about this. We want this number here in G57 to be 10% or more. Okay. And so we have to create capacity. You can create capacity up here by hiring people. maybe working working some overtime. Okay. You can also create capacity by eliminating waste.
Yep.
So what you can do in any of the cells that are white in column G, you can change the scrap rate, you can change the inspection rate, any of these numbers you can change. Okay, and you sort of play with this. Again, you want to also take into account how much money we're making here. Okay, because obviously if you hire people, you're going to have higher salaries, and it's going to calculate that for you. Increase the labor and increase the overtime. So anyway, that's, what would you do? What are your recommendations to create capacity? So it boils down to it could be hiring people only, improvement only, or some combination thereof. Like I said, there are many ways to get at this. So go ahead and play with it. It's about 5 after the hour. So I'll give you about 7 minutes to do this, then we'll talk about it, okay? And if you have any questions, I'm here. Just ask me, please. Anybody else need more, anybody need more time? Would anybody be brave enough to share their screen and show what they did? If not, that's okay. I just want to give you the choice, the
Sure,
chance. If you,
I can, if you want. Let
you
me-
should be, everybody can share screen, so go ahead. You should be able
Let me
to
Figure
it.
out how.
go down there. All righty.
What do you see? Not
I
what
see-
you're supposed to see.
I see,
Making sure I'm sharing the right screen.
yeah,
So I changed scrap and downtime, which got me to my 10%.
how much did you change it again? Okay,
Downtime 9 and scrap 8.
okay. And let's look at your value stream income statement.
Yeah, I didn't really look at that yet.
No, that's fine. No, it's, again, you, if you scroll down just a couple rows, so we can see the whole, up, I'm sorry, scroll up. That's good, right there. Yeah. Yeah, so we're adding revenue, we're adding contribution margin, we're not adding costs. And this is highly profitable. Look at what happens to that value stream profit. I mean, it more than doubles.
Yeah.
Now, this is what standard costing doesn't show. Standard costing would say, you have that sales price, which is like $35 a unit. You have this standard cost. And bang, this is how much money we're going to make, the standard margin. It doesn't take into account improvements. Anybody else? If you don't want to show, you can just sort of explain what you did, because I've done this a few times. I do this a lot with people, and it's very interesting. They come up with really good ideas that I didn't even think of. Anybody else want to share? You can just verbally say it.
Okay, Nick, I'm going to share, okay, yes.
Sure.
Yes, yes, and let me figure out the right screen first, right? So,
Yeah, just go to the bottom there, share screen, click on it, and it'll open up all your open windows. There you go.
hopefully I'm on the right page. You guys can see my screen?
Yeah,
See, Nick, I was trying to play around, right, with this one because I didn't get the 10%, actually I got higher, so I was trying to play around because I was trying to change this. Number one is cycle time per unit, right? So it was 10 minutes. I tried to play with, put in 9.3. That's why you can
Yeah.
see the yellow.
Yeah.
It's a 7% because I was trying to make this is a kind of like our whole company goal, right? Let's improve everything by 7%, right? So this could be a goal, right? So for whole company, right? So that's why I was trying to play around with it. So then I went to the scrap. I didn't touch the people. I didn't buy the extra like a machine or anything, that one yet, but I'm still looking what I can do with it, whatever I have it right now. So to get my capacity, right? So that's the first thing I'm looking into, right? Why I'm going to hire more people, why I have to buy new machine if I have something already available, right? So that's the
Mhm.
first decision I have to make it.
Yeah.
Then I was looking at the scrap and rework, right? And it seemed like every fifth item is going to scrap, which seems to me high, right? So that's another one I was trying to play it. So should I put 13% because I'm trying to play with 7%? It's a number, right? So again, you are saying like, so I'm trying to do it evenly, right? So this is the number I was to change it again, right? So this is little higher, so I have to put it 23%. Because I'm trying to go with the 3%. Let's see
Yeah.
what is going to happen, right? So no, I'm going to go with the 7% everywhere. So then I change my downtime. I try to make it easier, so I made it red, right? What I'm changing.
Uh-huh.
So still I'm at 6%. I'm not, no, I'm at 10% now. Exactly. So that's the exact number you are looking, right? If I'm looking at my bottom number, so my profit almost double, right?
Well, hold on. Where's that 36,000 in F71 coming from? Did you?
I did not do it. This one?
No, F.
Okay.
Column F. I think,
Oh, I maybe I was playing around something here. I plugged it to something maybe.
go all the way to the top. All the way up high.
Oh, I put it
Yeah,
here. No,
okay, yeah, that's all right. Yeah,
I try to,
there you go. That's okay.
yeah, I'm sorry.
No, you made more money.
Got you. So here you go. So I'm doubling up the profit too, right? From 18,000 to 44,000, which is went from 1094 to 21,7. But like to me as a learning this one, I'm trying to make one goal for whole company, not just for one person, for whole company, right? Let's approve this one by 10%, all the areas, you know?
Great. Anybody else have any questions or anybody else want to talk about what they did? You can stop your sharing now, I think.
Let me see, I have to, because I'm the team one, so I have to figure out that one, how to do that.
You scroll down, you should see screen share, and all you have to do is click on that. Or maybe, wait,
Yeah,
I'll stop it. I stopped it for you.
got you.
I'm the master here. I can do things like that. So what do you know, in general? Hold on, I didn't stop it. Hold on one second.
Am I the troublemaker now?
So what's do you see how the numbers can shift the thinking around? You know, as opposed to using a standard cost in decision making, if you're using the elements of the box score. I mean, it's if we one of sort of the aspects of lean accounting and getting away from standard costing is to improve, align decision making with lean thinking, with the numbers. I mean, I saw the similar results than that, like what you showed back when I was a CFO and I'm learning about lean and I'm seeing what happens. I'm seeing at the time it was a 75-year-old company that we grew sales 5 to 7% a year. We were happy. We made a good profit. It was not spectacular, but it was good. We had a profit sharing, so everybody got a little extra money in their profit. Everybody was happy. And we thought that was it. That's the way this business runs. We hire a vice president of manufacturing with lean experience, and he says, we're going to reduce our lead times to 3 days. We're going to be like 95% or better on time, and we're going to do it and we're also going to reduce inventories at the same time. And everybody thought he was crazy. But you know what? We got there. And sales are growing at 20%. We have profits we never thought of. a lot of the problems and issues that we had or were gone, our sales were growing because we had the shortest lead times in the industry. So customers were buying from us. And we had cash, we didn't have any problems financing the purchase of, buying equipment, things like that. And it was like, at one level, accounting became very easy because we were making all kinds of money. And it's always easy when you're making money. But we used to wrestle with certain things about, how big was the line of credit, because we thought that we had to build inventory in the winter to sell it in the spring and summer because we didn't have the capacity in the spring and summer. The fact of the matter is, because we had a high scrap rate, no, we didn't have the capacity. But once we reduced our scrap, we had the capacity.
Yep.
We didn't have to build that inventory. We never used our line of credit. I mean, the bank we'd have to renew it every year. And they say, would you please borrow on it at least for a few days? It was like stuff like that. So, it's, the box score will help align people, the numbers and the analysis and the decision-making with lean thinking. Okay, so I promised you pricing and quoting, right?
Yep.
All right, now I'm not going to do the whole presentation. I will be glad to send this to you though. And obviously, if you want to listen to the whole webinar, you can. I can send you that link if you don't have it already. By the way, we did talk about the overhead death spiral yesterday.
I would like the link to the,
Yeah.
to listen to it.
Yeah, I'll be glad to send it to you.
Me too.
Okay, yeah. All right, so how do you quote without a product cost? Okay. And again, there's really three questions everybody wants to know. What's the price that we would like to charge to make the kind of money we want? Now, that's what a standard cost does. You take the standard cost, you do the markup to get the margin you want. Okay. But the standard cost is not accurate. But I'm going to show you a way to do it. What's the price the customer is willing to pay? And then what's the profitability of this opportunity, or what is the expected profitability of this quote, given the fact that maybe the desired price that we'd like to charge is not the price the customer wants to pay. And if the customer wants to pay a different price, is it profitable or not? So there's two ways to calculate a desired price without a product cost, and one is the hurdle rate, the other is contribution per minute. Okay, and I'm going to go through this. I mean, we have we have about 7 minutes until break, so if I don't finish, we'll pick this up after break, and then we'll do the next section, because I don't want to go through this too fast, especially if you have questions. So hurdle rate. Here's how here's the methodology. You take your budget or some kind of forecast. And you could do this at a value stream level. You could do this at a company level, doesn't matter. What are the sales? What are the actual variable costs? Okay, I'm going to say the true variable costs. You calculate the contribution margin. You subtract your fixed costs, you get your profit. Basic equation that we all know from finance and accounting. So what you want to understand is, what is the fixed costs as a percentage of sales, and what is the desired profit percentage you would like to earn? Not what it is in the budget or the forecast, but what would you like it to be? So the contribution margin hurdle rate is the desired profit percentage plus the fixed cost as a percentage of sales. I'm going to show you an example of this. How do you use this to calculate the price? Pretty simple equation. The price is the actual variable cost per unit divided by the reciprocal of the hurdle rate. 1 minus the hurdle rate. That is the price that will give you the contribution margin you want. It will cover fixed costs and give you the profit you want. So the hurdle rate, the idea of the hurdle rate is, you know, you want to try to meet that or get over it in overall in your pricing. That doesn't mean that every single time you quote, you have to be over it. Okay, sometimes it's going to be under, and that's where you have to think about, you know, other considerations. So for example, if here's a value stream income statement projection, 35% operating profit, 22% fixed costs, hurdle rate's 57%. Pretty cut and dry. Any questions so far? So here's a way to calculate the price. So let's say that a customer, this example is a company that does truck repairs, okay? And it's they have two value streams. They have sort of the routine maintenance and the major maintenance. So this is like routine maintenance. So a company that has a fleet of trucks came to this truck maintenance company and said, we'd like you to perform routine maintenance on 500 trucks a month. So the variable cost, $17 per truck. Okay. The hurdle rate, we calculated at 57%. So the quoted price would be that equation. These were polling questions in the webinar, so let me just put up the next slide. So the quoted price, $39.53. Now, let's say that the customer only wants to pay $38. Then the question is, would you accept it or not? Under what conditions? We'll get to that in a second. Let me show you the second method, which is, so anyway, I'm sorry. Any questions? I actually did this analysis for a company that I'm working with. They had they were the owner, it's a smaller family-owned business, single owner business. The owner was very concerned. He says, oh, we're selling more, but we're not earning the kind of profit we want. And this is custom pricing. Every single order gets quoted. And actually what I did, I'm just going to go back a slide or two slides. Back in May, I had them redo their 2022 budget. And then I did basically this calculation. They have two value streams. And what came out was that, you know, the actual contribution margin was in both value streams was less than the hurdle rate, which means, you know, what they're doing now is they're looking at how they do their quoting, and they're using these hurdle rates. So when they prepare a quote, they now have the hurdle rate, and they can compare the quoted, they can compare what they're quoting to the hurdle rate to see, because they know the variable cost, they know the material, you know, are they in the ballpark or not when it comes to what the margin needs to be. And I told them, you know, their fixed costs are under control. I said, this is all about, you know, what your price, and what you're pricing at, they, like a lot of other companies, are having material cost issues also. Anyway. Let me advance. So we use sales. We get to contribution margin again. This time what we do is we divide the contribution margin dollars by the planned volume multiplied by the average cycle time. And we get a target contribution per minute. Okay, and this is based on the average rate of flow through the bottleneck. So what you have to do to calculate a quoted price is you have to know the actual product that you're quoting, what is its actual cycle time through the bottleneck compared to the average. And then you take this target contribution per minute multiplied by the actual cycle time, then you add in the variable cost to get the price. So here's an example where you take that contribution margin of 1.596 million, you divide it by the total time, 585,000 minutes, you get a contribution per minute of $2.73. So if you're doing the quote, you know that the variable cost is $17 per unit, and that the actual cycle time is 8.25 minutes. You multiply 8.25 by the target, $2.73. You add in the $17, you get $39.53. And again, if the customer wants to pay 38, is that profitable or not? What do you think? I've done this with a few companies. I know we're at break time. I've showed this to a few companies, and it's really interesting how the salespeople really love it. Because it's faster. It's easy to calculate. What it also does is I don't know if you've been involved in these discussions at all. Do you ever get involved in the standard cost arguments? Why is the cost what it is? Or heated discussion, just let's say discussions. Why is this cost this much and this cost this much? I don't understand why this, the products are similar, and you get into all this sort of non-value added discussion, let's call it that. Or sometimes, like people in sales and marketing, they know they can't get a higher price. They have a general idea what the customer is going to pay. So what they're trying to do is they're trying to say, we got to take cost out. How can we change the standard cost so I get the margin? Sometimes that happens too. So anyway, was that helpful?
Yes.
Okay.
But
All right.
So Nick,
Yeah.
I have another question. It's just learning purpose, thinking little bit here, right? Because now you are coming up your variable cost coming from budget or forecast, right?
Yeah.
But now I have a just quick question, right? If like inflation is happening 30% and we prepared the budget last year, and now we have agreement with the people like for annually, right, where we can change the price. So how you see that, right? Like now all of a sudden, like our variable, so now how you guys are explain in lean world, right? That's now I'm kind of stuck, right?
Yeah. I mean, by the way, that question comes up with every company I'm working with right now. I mean, we're living in, so the economic conditions are so unique right now that it causes a lot of sort of thinking within companies to be challenged when it comes to costs and raising prices. Another company I'm working with, they've raised prices about 3 or 4 times this year. They just keep raising prices. Because they have to, I mean, you really, I'm not an economist in any way. And, I have my little company here that I run. And I don't work in a company where I'm faced with those challenges, what are we gonna do about prices and how are we gonna tackle these runaway costs? But, lean thinking can be applied. It's about problem solving. Okay,
Got it.
and you may not have much control over supplier pricing. You may not have much control over delivery. You might have to, I don't know, you might have to buy a whole lot of inventory when it's available because you don't know if you're going to get it. But that's just the reality right now. And then when it comes to pricing, you have to go through the sort of the PDCA approach or an A3 about what do we do about pricing? What are our options? What's the impact going to be if we pass all our price increases along? I mean, it's a ripple effect, we all see that going to the grocery store right now. Okay. I went 5 minutes over. So let's come back at 5 minutes after the hour, okay? For session 3. Sound good? All right, see you in a bit. Hold on. Sorry. Anything anybody wants to make sure we talk about before the end of this session? Okay. All right, so simplifying standard setting. Now, there's a lot of detail that goes into this. For material costs, it's all the information on the bills of material. Then you have setting the labor and overhead rates. And so let's look at how to simplify this. Again, and I'll repeat this a lot in this session. The goal, we still have to value inventory using standard costing. How can we do this in the leanest way possible without being concerned about variances, without being concerned about absorption, and without being concerned about what is the profitability of a particular product? So, bills of material. Why are they traditionally complex? First of all, the number of bills of material. Every item that is reported as reported as completed production, and that would be some kind of subassembly, and obviously all your finished goods. They have to have a bill of material. Okay, because the bill of material takes the material out, and that combined with a work order, it turns it into a finished good. And so anything you have to report as completed production needs a bill of material. So that's what drives complexity. I guess another thing which drives complexity, which I don't have written on here, is if you have custom products and you need to create like a new bill of material every time you're quoting a new product because there's a little bit of a change in there. So that's what drives complexity. Now, what from a just strictly a lean operating viewpoint, what can drive simplicity is that if you begin flowing your work, those subassemblies may not have to be reported as completed production because they're flowing, you're building the subassemblies and maybe they're going right into the final assembly of the finished good. So you have the opportunity to eliminate all those sub-assembly bills of material. And you know, even if they're sitting in some state, you know, maybe the sub-assemblies are being produced, but they're not sitting for long, that's still an opportunity where you can basically take the sub-assembly items and put them on the finished good bill of material. So you have an opportunity to reduce the number of bills of material. If you think about the number of parts or line items on a bill of material, okay, that can be very, very detailed. What typically drives this in sort of traditional manufacturing is MRP and purchasing, okay? Where the ERP system is wants everything listed on the bill of material because it's going to basically tell you what to order and when to order it, okay? So you can get very granular with your bills of material. I mean, I even worked at a company that, I mean, literally, I don't remember the exact part, but you know, they had their bills of material were so detailed. They had inventory items which were worth cents as inventory items. And again, it was all because they wanted MRP to do the purchasing. And then you get into the inventory control issue. From a lean viewpoint, if you have a pull system and visual control of inventory, you don't need that transactional control. I mean, if you have supermarkets out on your shop floor, that limits the amount of inventory, okay? So there's an opportunity there where you can reduce the number of parts or line items on a bill of material. Then there's the quantity per assembly. You know, what's the quantity that we use to make the product? A lot of that is done for costing purposes, also for purchasing and inventory control purposes, okay? And, you know, it's like one of the issues is on the quantity per assembly is you factor in a yield factor. How much do we think we scrap? Because what you're trying to do is you're trying to tell MRP when to order based on some yield rate. So, you know, the lean drivers of simplicity, you have pull systems from your suppliers, you have visual shop floor controls. You don't need that transactional control through the bill of material. Then finally, there's the material cost, okay? Setting standards, okay? And a lot of times setting the standard material cost is about, you know, understanding variances. Someone talked about, or earlier today talked about, you know, how much time is spent analyzing purchase price variance. And so again, if you're not too concerned about using purchase price variance, just establish what the standard is. Maybe the standard can be the average or the last price paid, because you have box scores to understand your true costs. All right, so this is going to sort of be a little bit of a discussion. I'm sort of gonna ask you to put your lean thinking hats on here, okay? And think outside the box. Don't think necessarily about your company. So reducing, we want to improve, we want to look at the number of bills of material. And like I said, the number of sub-assemblies, finished goods reported as inventory. So what are some lean improvements that you think you could make to reduce the number of bills of material? This is sort of just brainstorming here. I'm gonna put up the answers later. Any ideas?
When you ask about reducing the number of bill of materials, do you mean the number of items on a single bill?
No,
Or
this
the
is just,
number of SKUs that have a bill of material attached to them?
right, the number of SKUs that have bills of material.
And what's
We're gonna-
interesting to me for this question is I have a planning department that wants to increase the number of bonds that they, because they want. I do. I don't know what else to say.
I've heard that before. I understand. Why do they want to increase?
Because they don't pull orders through the plant. They
Push.
push.
And they're probably heavily into MRP, right?
Trying to be.
Can I ask why you would increase, so for us, we only have bill of materials on finished goods. So would you be adding more SKUs or why would you?
That's what they do. They'll add a SKU for a sub assembly, and like when it finishes this work center, they assign it a SKU
Oh,
and it goes into the next process. And for some reason that's helps them plan their work centers better because they push, they don't pull. So we don't have to go down that rabbit hole, but
Yeah, MRP is designed to do a whole lot of things. But it's just it's another estimator. All right. Any
So
other?
would that be like, instead of creating a work order, you would create a new
Yeah.
BOM for a whole, okay.
no, it actually increases the number of work orders you have because you have a work order per SKU.
Yeah.
Instead of a number of operations on one finished good work order. I mean, we buy companies and change it. So I don't know. I'll just give up.
Let me just go. All right, so. You can do finished goods only. You can also have one-time configurable bills of material. Okay, if you have a lot of custom products, that's sometimes a feature in ERP systems. So, rather than maintaining this massive database of custom products that are only going to be ordered once, these are some opportunities. How about the number of line items? Okay, so we have purchase items, sub-assemblies. What are some possible lean improvements to reduce the number of line items? Here they are. Okay, eliminate the sub-assemblies. Okay. And, there really is opportunity to possibly convert some items that are listed as inventory and just expense them as consumable supplies. And not worry about it. This is especially true, like where you might be using like liquids, or you're using stuff that is not, that sort of is more on volume.
Yeah, we do that with gases.
Okay, yeah, that's a good example. I mean, it's very hard to say how much you're going to use, per unit. And you might use a little bit more, you might use a little bit less, so just expense it. And then you don't have to worry about all the issues that go around with inventory and material usage variances and stuff like that. quantity per assembly, traditionally it includes yield rates. What would you want it to be? Or other, like what I would call fudge factors. Okay, it's not really it's designed, the quantity per assembly is almost more designed for MRP and purchasing than actual usage. Just put the actual quantity used, okay? Especially if you're measuring scrap or defects, you don't need to include the yield rates. And if you're using any kind of sort of Kanban system to signal purchasing when to buy, again, you don't need to have yield rates in there because MRP is just used for planning purposes, not to determine the actual purchasing requirements. Finally, unit cost. So you can create a standard. What else could you do? What could you do? I mentioned this earlier. Instead of going through the idea of creating a standard, what are some other options, especially if it's either a commodity or you're in an environment today where there's a lot of price fluctuation?
Last price paid, is that?
Yeah. Last price paid or average price paid. And like I mentioned earlier, many times this is like just a switch, a setting switch in your ERP system. I mean, one company that I was working with last year, they were having the problems that some of you are having with material costs. Well, steel, that was their biggest product, or their raw material, but they were spending an inordinate amount of time trying to determine a standard and then trying to keep the standard up. And we actually did look in the system, and they were able to switch it to, last price. I think they're using average cost, and so they made the simple switch, and life is a whole lot easier for them because they have less work to do. So again, these are what these improvement opportunities, what I call them. These are things that I've seen over the years, that either working directly with companies or hearing about what other companies have done. But so what you have to do, and I know that, like, you might have planning may be in charge of bills of materials, or in other companies, it might be the engineering group. It's important to work together, okay, and just see if there's opportunities to simplify. Because, like you said, Lori, here you have one group that they want to increase. They probably want more detail. They have a reason for it. So it might be that you might introduce them to other information which might serve them better, to prevent them from going down that detailed path. Any questions or comments? Oh, by the way, we're getting a bad storm, and the lights flickered a minute ago. The power didn't go out, but if by some chance you stop seeing me, we've had a power issue, and we'll deal with it. But I don't know, the neighborhood we live in, sometimes the wind blows too hard and the power goes out for a while. Sometimes we have bad storms and nothing happens. Anyway, just want to let you know if something happens. Questions, comments, ideas?
In the steel market that we have today, do you think it would be wise to do the last price paid? Or what do you think? What would your recommendation be on that?
I personally think so. I mean, only because, the standard creates the variance. And if people are looking at the variance and saying, why do we have that variance? But the answer is obvious. We have price fluctuations.
Mhm.
So there's very little control over that either. I mean, you might be tied into one supplier, or you might go to another supplier, but the other supplier might say, well, I have a similar price because I'm having problems sourcing my material. This whole supply chain thing has ripple effects.
Mhm.
And so it just eliminates, okay, it's the last price paid. We have fewer variances to look at. And even from a product costing viewpoint, yeah, well, the cost changes because the price is changing. So that's sort of the way, if I was like in one of your positions, that's what I would be pushing for, because also you just don't have to worry. Nobody has to sort of go through the process of determining the standard. I mean, sometimes that's easy. Sometimes that's difficult. What should the standard be? Okay.
Okay.
All right, now we get into the labor and overhead rates. So number of rates. Okay, now, again, I go back to, a lot of details to create a quote unquote accurate product cost. Okay, so that's sort of we're trying to get away from that thinking, and it opens up opportunities. So the number of rates is typically driven by the number of work centers that you have. Okay, you may want to have, I've seen this, you might have a lot of work centers and you try to get to an accurate labor rate for each work center. Again, that's because products go through different work centers. Okay. When you get into, when you look at this from a lean viewpoint, we're not using that product cost to analyze costs. We're just using it to value inventory. We have value stream costs we can look at. So can we reduce the number of rates? We can, for example, right now, you can keep the same number of work centers, but can you have fewer rates? Ideally, you have one rate for the entire factory. Now you get into the run rates. Okay, so this is how long does it take to make the product in the system, and that run rate's going to be multiplied by the labor rate to get your direct labor dollars. Again, we have lots of detailed run rates to maximize absorption. Okay, that's really what we're trying to get at. If you have visual controls and performance measurements in place in operations, you don't need to be too concerned about the rates. And you don't have to worry about maximizing absorption. So can you simplify the run rates? That company I told you about that I worked in last year, regarding, they really wanted to look at their whole standard costing system. What was interesting, I told you about the material piece. When we were looking at the labor and the overhead, I asked them, how often do you update rates? And how many rates do you have and how often do you update them? And they said, oh, well, we haven't looked at that in about 5 or 6 years. Okay. Well, you're wondering why your product costs are coming out differently than what you think they should be. Well, that's one reason, but they had a tremendous amount of work centers and rates and run rates. And it was one of those things which nobody wants to look at because it's too detailed. So they just kept them the same. But we got them on a plan to work on that. All right, so then you have the work centers. And the work centers are related to the steps in the router, okay? Now, this is about production control, reporting transactions, and also variance analysis and detailed product costing. So if you're flowing, if you have visual controls in place, if you're flowing the product through value streams faster, you don't really need the production control by transaction. You can use the visual controls. So you have an opportunity to reduce the number of work centers, and that also reduces the number of steps, router steps on a work order. Ideally, you should try to drive to, one work center per value stream. The work center is just value stream 1, value stream 2. We're not too concerned about everything in the middle. Then there's the number of routers. This is sort of related like to the bills of material. Every item that needs to be reported, completed production, you need a router for it. The router's on the work order. So if you eliminate subassemblies from having to be stocked, you can reduce the number of routers. So if you have a router for each part, you can go finished goods inventory only. You can reduce routers. Line items. Each production step is a line item. What could you do on the number of line items on the router, or the number of work centers on the router? What would be your goal? How about 1? Okay. Because remember, every step, every router step has to have a transaction reported against it in some form or fashion. The run rates. I've seen companies that in their run rate, they include setup time. It should, instead of or maximize to include setup time, it should be to maximize absorption. Okay, that's what they're trying to do. So what should your run rates really be? You're not concerned about absorption anymore. You're not too concerned about detailed product costing. How about just the actual cycle time on the value stream maps? Make sense? And finally, setting rates. So we have a lot of detailed rates for accuracy. What would be the lean improvement approach?
Less detailed rates.
Yeah. I mean, 1 labor rate, 1 overhead rate for the entire facility. Remember, at this point, all we're concerned about is the macro valuation of inventory. We're not too concerned about each individual product. And if you think about it, if you think about this whole standard costing system and the standard setting and how the costs get allocated based on all of the based on the configuration and the assumptions, that it's the analogy that I heard many, many years ago is it's like, spreading peanut butter on a piece of bread. you can spread it thick or you can spread it thin, but you're still spreading it on the same piece of bread. And all you're doing when you start with all these detailed rates is you're just spreading the peanut butter differently around, you're spreading the cost differently around over the different products. And I actually did this. This was one thing I did as CFO before we got to lean inventory valuation, is we just adopted, I think we had like we may have had like 2 labor rates. And that was it. Actually, no, we had 1 labor rate. We did the same, we did it with machine rates because we had in an injection molding department with about 8 to 10 injection molding machines. And we used to spend a great deal of time studying or trying to allocate the cost, the molding department cost to each machine. And, spreading shared costs. We used to look at the utilization of each machine and we developed these machine rates, which is the equivalent of a labor rate, but because the machines do the work, it's just a machine rate. And we came up with these wild rates. Okay. And it used to drive marketing crazy because they did a lot of quoting of orders, and they would literally, people would show up in my office with like this report, and they would say, well, here's product A and here's product B. Now, no, I'm sorry, they wouldn't show up with the report, they'd show up with the product. And these are, our primary product was hard hats, okay? So they'd show up with the two different models of hard hats, which looked exactly alike, okay? And they may have had just slight, they pretty much were the same product. They may have had a different suspension, which is what goes around your head. And they would say, this product costs X. This product, which is just like this one, costs, 3 times more. Why is that? So one of us would get oh, well, this product runs on machine number 5, and machine number 5 is utilized 90% of the time. This one is typically run on machine 8, and machine 8, nobody likes it, so they don't run much on it. And so it's utilized only, 30% of the time. So it is a higher machine rate. And basically, when we went to just like one general machine rate for the entire molding operation, it just sort of took away all that discussion. And actually the rates were much, much more reasonable. So that's just a story about, opportunity. So in terms of simplifying the standard setting process, do any of you see right now, like today, do you see any opportunities to possibly eliminate some unnecessary work?
Yes, just not sure how to get there yet.
Right.
We
What do
have many,
go
many,
ahead.
many overhead buckets that are all on an allocation. And like I said, if it's grapes from 3 years ago, the overhead has to span 3 years. So we have to take that into account too. And it's just a nightmare.
So if the wine, this is because the wine has to age for 3 years?
Yes, so we bring in grapes this year and we won't sell the product. We won't bottle and sell the product for 2 to 3 years. So It sits in the cellar in a barrel or a tank, depending on what it is.
Okay.
So we have all those cellaring costs and everything that accumulate.
Oh.
We do it by months in the cellar is how we,
Okay, yeah,
but
interesting.
it's still a mess. And then someone asks me a question, I have to go figure out what happened 3 years ago. So
Oh. Okay, yeah, that is unique. Great. Anybody else? See any opportunity possibly? I know, Lori, you want to talk to planning, right?
Yeah, I think I'm in the same boat as, I see opportunities. I'm not sure how to get there in the existing environment that I work in.
Yeah, well, I think one thing is, I started down this path. Primarily, you know, we weren't, when we started doing this work, we weren't really on the lean transformation path yet. But what we were on, you know, but we were, there was a group of people who were very tired of trying to explain everything that was going on behind the scenes with standards and stuff. And it was primarily me as CFO. It was the Director of Information Technology, who, of course, he would always be asked a lot of questions about, you know, how the system works and where do these numbers come from? And, you know, that's not exactly a lot of value added work. And then there was a manufacturing manager who, you know, he was tired of all the questions about variances. And so what we sort of did is we got together and we started working together to try to just figure out how to simplify things. So part of it was the standard setting. Part of it was this transaction elimination, which I'm going to talk to you more. But what we did is we did spend a lot of time studying how the ERP system, you know, what it, you know, here's, you know, the certain information was in tables. And when you perform certain transactions or whatever, it would read information from the tables. And then we actually sort of figured out how it created a lot of these variances and stuff. And so, and then, you know, the IT director also found some hidden features in the ERP system that we didn't know about that really started simplifying things. So it's, that's sort of the approach I would take. I mean, you, at one level, you have to find some allies, like I just mentioned, some people who sort of feel the same way that you do about things. And the more that you make it cross-functional, the easier it is. Okay. Transaction elimination. Well, this is really about, you know, ERP systems and everything. So here is a typical traditional type value stream map. I'm sorry, this is a value stream map of a very traditional type manufacturing process. So you have scheduling and MRP, they're sending work orders to each of the process steps. They're sort of working independently. You have a lot of work in process in between those steps, and then you have your traditional purchasing via MRP. So what would be, 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 what would be transactions or transactional controls which have to be in place. Okay, because you have a lot of stuff going on here, and the idea is that the ERP system creates transactional control. So, for example, what do you need to do with all of this, either the raw material or the work in process, to make sure it's accurate?
Like a QA check?
Yeah, QA check, right? What other things have to be done? If you're issuing work order to every production step, what does that mean? What do you have to do to work orders? To make, you have to report transactions, right? You have to do production reporting.
Right.
How, you know, it's sort of very common that the flow of the materials is not, I'm sorry, it's very common is that the flow of the transaction reporting doesn't keep up with the flow of materials. So for example, when it comes to work in process or finished goods or raw material inventory, you can look in the system and it says a certain quantity, but if you were to go out on the floor and count it, it's a different quantity. So what does that then create? When that's the case, what kind of program do you usually create? Not a software program, but what kind of material management practice do you usually put in place?
Cycle count?
Cycle counting, that's right. So, you have to track your quantities on work orders, track actual quantities. You have to track labor and materials also. You get variances. You have to do cycle counting, on receiving inspection. You have to compare the receiver to the purchase order, and eventually in accounts payable to the invoice. So there's a lot of transactions which have to go on. Sometimes these are system transactions. Sometimes these are things like cycle counting, which ends up being a system transaction, but it's a physical activity. So here's my question. How effective typically is transactional control? How many times, let me ask it a different way. How many times have you heard about people trying to look in the system for what's the quantity on hand, or what's the work in process quantity, or, even report, even where is the work order in the production process, and they don't have confidence in what the system says? Have you ever encountered that?
Yeah.
Yeah. So this is where the opportunity exists when you have lean controls. Lean, basically, the visual controls of lean replace transactional control. So even if you just look at, compare compare the circles to this one, there's a lot fewer transactions. So if you look, from the beginning up top on purchasing, as opposed, you can do like blanket POs, master POs, you can certify your suppliers, certify only the good ones. On the receiving end, right here, you could have vendor managed inventory. You have visual control of inventory. You have limited, this symbol here is a supermarket. Does everybody understand what a supermarket is in lean production? If you don't, I'll be glad to explain it.
I don't.
Okay, that's fine. So, this is the story that, the story is when the Toyota people came to the United States to visit, they went to the grocery store and they were amazed at the supermarket, and if you think about the supermarket, products are assigned a certain amount of shelf space, right? Which limits how much inventory there can be out there.
Okay.
Right?
Yep.
And then what happens? I go into the store, people go into the store and they pull what they're buying. And then what happens after that? Either someone in the store or the supplier, they replenish that space, but they only replenish it to this maximum quantity.
Right. Okay.
So what supermarkets do is they limit inventory. They create a maximum amount of inventory that you can have. And so this example here where you see the pull,
Mhm.
let's look between machine shop and welding. So what happens, this is how lean controls production. So as opposed to using work orders, the machine shop is going to respond. They're sort of like the delivery man or the bread man that comes to the supermarket and fills up the bread shelf. So when welding pulls here, when they pull the part here to work on, machine simply replenishes, but they never make any more than the maximum amount in the supermarket.
Yep.
And then because the assembly process is faster than the welding process, it just moves first in, first out, meaning as soon as welding finishes one, assembly can work on it because they're faster than welding. And then again, it goes into shipping. So you have a lot of visual control of inventory. You're making to order. So here we have a customer order that comes to welding. That's the only place where you have a work order. The machine shop doesn't need a work order. The supermarket is its signal. Assembly doesn't need a work order because they're just going to, whatever they see, whatever arrives, they work on.
Mhm.
So you don't need all those transactions.
Got it. Makes sense.
And this presents a great opportunity in work orders. So let me ask you, what is the primary purpose of a work order? It has one primary purpose.
To define what's needed.
That's a use. That's not the purpose I'm thinking. But we're going to talk about that anyway. The primary purpose of a work order is to take the raw materials and in the system, all I'm talking about is in the system. You need to have a work order that takes those raw materials, converts them, when you open the work order, puts the materials in WIP. When you close the work order, you create the finished good that you can now ship. That's really what a work order does. But I call work orders like Swiss Army knives. They can do a lot of other things. Okay. So if you're like this, or when you don't need as many work orders. Okay, you have visual controls in place. So what you can do, here are some things you can do to reduce work order transactions. Number one, stop reporting actual to work orders. You can do that. You can do that today. Okay. Stop reporting like actual labor or actual material to the work order. The work order is working at standard. And every time you report actual to a work order, all you're doing is creating a variance. So just stop reporting actual. You have lean performance measurements in place. I mean, you don't need the variances. You have other things which are creating the control of performance. We actually, again, this is one thing that we did even before we were lean. You know, we looked at when you report, how does the system use the information? And like I said a minute ago, it just created this labor variance. And so we experimented with it and we stopped reporting actual, and the variances went away, and we just said, okay, we're going to stop doing that. Okay. Back flushing. Okay. Does everybody use back flushing? Does anybody not know what it is? Do I need to explain it?
Yes, Nick, could you please
Yeah.
explain?
Okay. Let me, yeah, okay. I'll do this verbally. I could call up a slide from another presentation if you want. But let me, if you don't mind, let me I can find the presentation really fast because it was in a webinar that I did last month. It's easier to do it visually. All right, so hold on. All right. So let's say that you have a work order that has 10 steps in the router. So what you have to do without back flushing is you have to open the work order, you have to close the work order, and you have to report completion at each step. So you have 12 transactions you have to do. Okay. backflushing, what you do is and this is a feature in most systems, most ERP systems. You can designate certain steps in the process where you report. You don't have to report to all of them. So what happens is you open the work order. You don't do any reporting at step 1 or step 2, but when you report completion, when you report step 3 completed, the systems then says, oh, that means you also completed step 1 and step 2. And then when you do at step 5, it says, oh, well, you also completed step 4. Same thing at 7. You also completed 6. Then when you close the work order in this example, it says, oh, yes, you also completed 8, 9, and 10. So what you've done is instead of 12 reporting transactions, you now only have 5. And, backflushing and reducing the number of steps in the router, they sort of accomplish the same thing, less reporting. Less transaction reporting. Because the interesting thing about transaction reporting is that, every transaction that can be reported is an opportunity for what I would call an inadvertent error. You can forget to report the transaction. You can, the wrong quantity can be reported for one reason or another. So again, you're reducing the opportunity for errors. So you can really, reduce work order transactions through backflushing or reducing the router steps, which would mean, as opposed to having 10 unique steps, you might, you may only have 1, 2, 3 router steps. Ideally, you'd like 1 router step, make the product. Everybody get that? So backflushing or reduce router steps, again, you have performance measurements in place. You don't have to, you're not concerned about variances, especially, reporting each step in the production process. The only real purpose there is that if you see a variance that you don't like, you can go into the report and you can say, oh, well, step number 5 is where the 80% of the variance was reported on this work order. And you can go ask the people who work there, why did you have a variance? So 1-step router, and then, like I said, decreasing the number of work orders. If you can align work order, a lot of times you may have already done this, but if you can align the number of work orders with your just customer orders and not be sending work orders to each production step, the work order sort of just follows the flow of materials. That's good. Thoughts, comments? Have any of you done any of this?
Some.
As I mentioned, we're kind of going the other way, and
Yeah.
honestly, we used to backflush more than we do now, and
Okay.
it's curious to me because it's coming from people that have had Lean Six Sigma training from
Oh,
so there's something being left out in their comprehension of that in a way in my head.
Mm-hmm.
But the other thing that I struggle with even trying to push this forward is that we have products that require a different level of labor,
Mm-hmm.
a different, in relation to their total cost as defined by standard costing. you know.
Right. Yeah.
And so I struggle with being able to make good decisions if we assume that they all get the same amount of labor applied to them.
Yeah. And I understand what you're saying. And, this is sort of, where do you start on all this? I mean, this stuff I'm talking about, you have to have other things in place, and primarily, there's a level of changing thinking about costs, changing thinking about how costs are managed. That's what we talked about, like in sessions 1 and session 2. And so you sort of have to get that in place. Then the idea of the number of labor rates, can we adjust those? That may make more sense because people have something else to use. And it goes back to what I said about numbers driving thinking. Okay. We're talking about solving the standard costing problem, and maybe I need to do this for the next course I do like this. Maybe I need to talk a little bit more at the beginning that you're really trying to change people's thinking.
Mhm.
And if you focus on that, then it's a lot easier to create a plan and understand what to do. Okay, because it sounds, based on this, you'd say, oh yeah, we'd like to, like to do this, like to do that. But as I said earlier, you can't just pull the carpet out from under people, because they will resist. They'll do a whole lot, even though your intentions are good. So you sort of, try to pull the people in, develop sort of the kind of relationships where you can have honest discussions about the numbers and thinking, creating a lean accounting pilot where you have a working box score for a value stream. And when you can demonstrate that, especially if you have lean practices in place, and when you can demonstrate how the box score works and how it improves decision-making, when you have that in place and people see it, then it's a whole lot easier to start talking about some of these difficult things we're talking about now. Any other questions, comments on work orders? Okay, we're getting down close to the end here. We talked about, basically, we sort of touched on this with these value stream maps, this idea of controlling material via transactions in ERP systems. It's pretty much determined by, how do we purchase? How do we understand what orders to ship? How do we find items? Where do we store items? And then what's the status of work in process inventory or orders? I mean, an ERP system in my Lean CFO book, I called it the ERP beast. I mean, it is a large database that will track and store any amount of information you want, under the assumption that you can sit like we are and you could look at a computer screen You can call up a report, you can search for a product, and you're gonna get all the information you want looking at that screen, and that helps you make decisions. But, you know, the fact of the matter is, and I said this before, I'll say it again, it is very, very difficult in all companies, large and small, for the volume of transactions to keep up with the material flow. And if you have a whole lot of, if you have a lot of inventory, it's even worse because, for example, you know, people forget to report transactions. When it comes to material movement, I'm supposed to take this product and put it in this location, but that location is full. So you know what? I got to get back to this other material I have to move. So I'm just going to put it someplace else. And then your system quantity is off. So a lot of things can happen. And that's why I always tell sort of senior leaders when it comes to lean, you know, focus on reducing the number of days of inventory. Less inventory makes life a whole lot easier. All right. You want to see lean inventory valuation? We have like, you know, we have about 15 minutes left. I can go through this.
I would.
We can talk about other things. It's up to you. We have an exercise here, but what I'll do is I'll just do the exercise for you. I'll show you the answers and stuff. All right, so lean inventory valuation is sort of the analogy I use for accounting teams is that it's the pot of gold at the end of the rainbow. When you can move to lean inventory valuation methods, and basically a lot of the work of setting standards and transaction reporting just simply goes away. Like I said, I've done it personally. I've worked with companies over the years that have done it. And I will say this, never once has an auditor said no. They also like it. It's simpler and easier for them. So, you know, what has to be in place? Number one is you need less inventory. The target, if you have 30 to 60 days of inventory, that's probably that's probably when you can look at this. Now, I have worked with a few companies that they've had more than 30 or 60 days of inventory and they've still do it. The financial reason you can do it is that when you have less finished goods and less work in process, the risk of misstating inventory on the balance sheet goes down because it's not going to impact profits that much. At Bullard, our finished goods inventory was pretty much what was on the shipping dock that was going to go out the next day. That was it. That's how fast we produced and stuff. And we actually never worried about work in process because it was so fast. We had raw materials, we had finished goods. So when you get to generally accepted accounting principles, you know, I don't know if you know this or not, I've written a few articles about it. Generally accepted accounting principles do not say that standard costing must be used. Okay. What GAAP says is that you have to create a cost flow assumption. Okay. And basically you have to use the cost flow assumption on a consistent basis because it's too hard to try to value every item on actual. So without going into any details, the cost flow assumption for lean inventory valuation is average cost. Okay, so lean inventory valuation is pretty much how do we calculate the average cost of inventory. So for material, it's really a function of how many SKUs you have. So if you have few SKUs of raw material, you know, the value of material is the cost times the quantity. So you can do a monthly physical and you can get the average cost per unit or average cost per day from your value stream income statement. That's not the case in most companies, though. Most companies have many SKUs. So what I recommend, you continue to use your ERP system to track quantities, because it does do a pretty good job of that. And the alternative, which would be trying to do it in Excel or something, would be a disaster. Really, the issue there, where you want to, the change you want to make is get away from a standard cost and go to average cost or last price paid. And that's how you value material. And that's actually what we did at Bullard, and what every other company I've worked with said, keep it in ERP, just change what the price is, what the cost is. The real benefit is capitalizing production costs. So right now, in the current state, capitalizing production costs is done on a product by product basis. Every product has a labor rate and an overhead rate. You report production, it goes into inventory. Okay, so that's the absorption. And then when you sell the product, it comes out of inventory, goes to cost of goods sold. But as we talked about, there's a whole lot of maintenance behind that. So the idea is we're going to capitalize total average production costs. And we're going to do it by a journal entry. We're going to do it at a macro level. We're not concerned about each individual product anymore. The benefit, labor and overhead rates are set to 0. Like I said earlier, when labor and overhead rates are set to 0, that also eliminates absorption and eliminates variances, because 0 times anything is 0. Your inventory value in your ERP system is at material cost. Everybody understands that. I mentioned earlier, or a couple minutes ago, you want to get the auditors, if you have them, whether they're internal or external, get their buy-in on the methodology. I think when you bring them in early in the process, what you're trying to do there is develop an average cost valuation methodology that they can test. And I will say this, they really, really appreciate that. Okay. And they actually have some pretty good ideas too. That's the other thing. So how does this work? Okay, so I'm going to switch over to the Excel file. And I'll show you the exercise. Okay, so the first step is to, we have a value stream income statement. We're in the averaging method. Okay, we're going to average based on average production costs per unit. You can use average production cost per unit. You can use like days of inventory. There's a few different methods, but I just want to show you one. So here we have our actual costs for the period. Okay. We know how many units we produced. Well, and so, well, actually, I'll just show you the answers. I don't have to do it for you. I got the answers. So if we have costs of $876,550, that's our actual production costs for the period. We produced $22,861. The average production cost per unit is 38.34. So then what you simply do is if you know your quantities on hand at the end of the period, obviously raw material doesn't get any production costs. Work in process, again, make a simple assumption, 50% complete. So what you do is you just take the 38.34, well, multiply it by the 3,430 units, multiply that by 50%. So the production costs, which need to be capitalized on the balance sheet at the end of the period for WIP, 65,758. Then finished goods, you just take the quantity on hand, multiplied by the 38.34, 175,341. So this is what needs to be on the balance sheet for capitalized production costs. So that's our ending inventory. If the beginning inventory of capitalized production costs is 296,509, we're making a journal entry for 55,411. So we're going to credit inventory and we will debit capitalized production costs on the income statement. And you have valued inventory for production purposes. I mean, for financial reporting purposes. What do you think about that?
Like, this is good, but it's too simple.
I agree.
It is that simple.
But all units aren't equal. I mean, I'm back to that argument.
Right, but we're not concerned. We're not concerned about each. We're not trying to value each individual unit. We're just trying to value it in total. I know I'm introducing one of the sort of radical concepts at the end of the workshop. This does work. I have never had, like I said, I've never had the auditors of a company that wanted to do this that I've helped them with. I've never had the auditors say no. Okay. Now, again, you have to sort of take this concept and make it work for your company. Okay. But if you think about sort of, okay, we're going to use the journal entry approach, you know, you might have to break it down more than I did, you know, but if you think by value stream, most value streams, the products that flow through the value streams have similar characteristics. So you're not going to be that far off if you do it value stream by value stream. You don't have to do it company as a whole. That way you sort of keep the differences in the production costs. So again, like I said, there's a few other methods that can be used. I'll be glad to share them with you, you know, after this workshop. We just didn't have time. So again, you know, this is very company specific. Sort of take the concepts, make them work for you. But the idea of, you know, having fewer labor and overhead rates, that's a big improvement right there. Okay. Being able to have no labor and overhead rates, well, certain things need to be in place. But I think it's really important to sort of keep this in mind. Okay. Talk about this inside your company. You may not be there yet. You may not be there for a few years, but don't stop talking about it because it's a great opportunity. Okay. So, you know, what do you want to do? This is we're sort of wrapping things up. You know, you want to measure operating performance. without using variances. They just don't work. Like I said earlier at the beginning, if standard costing, if you have lean practices in place or you're going to go down the lean transformation path, standard costing is going to bump into lean. And I always say that it's best to deal with something like this sort of proactively rather than reactively. Okay. And again, all these things we talked about, you know, you don't have to have a plan in place tomorrow. But, you know, I really wanted to make you aware of all the issues that are around standard costing. And if you're aware of the issues in general, you know, what we've seen in other companies, now you can start seeing if they apply, how they apply to your company. The real key, your lean management accounting system should be separate from your inventory valuation method. But when you have a standard costing system, they're sort of intertwined. Okay, and that's what you're trying to do is separate them. So, you know, I've showed this slide a few times, and there's not really a whole lot more to talk about. Actually, that's a duplicate slide. So really, you know, work on eliminating the information that's not, that I would call like anti-lean from management accounting. And then work on simplifying standard setting. Long term, you can focus on eliminating standard costing. That's sort of the approach. So, did you learn anything today?
I think I did.
Yep.
We have a long way to go.
In my head.
Yeah, that's okay. There's nothing wrong. Hey, you know, you know, lean is a transformation. You know, sometimes people describe it as a journey. And this whole, you know, whether it's lean accounting in general or dealing with standard costing, it's the same thing. Okay, you know, there is no end. There's just trying to improve. And so, you know, the more, however standard costing is impacting your company, the more that you can just, or at whatever level you can eliminate unnecessary work, you can eliminate waste, you can simplify. That's all improvement, and that's good. And you have to work at a pace for your company. You have to work at a pace where how lean is working too. Okay, you sort of can't just go off and turn off standard costing tomorrow. Although I've worked with some companies or done webinars where people say that's what they want to do. So,
I mean, if you talk to our production people, that's what they would say, because
oh, I
it
know.
doesn't help them. And I get into this argument all the time, so that really resonated. But yeah, I think my first step is to just get out into production and talk to them, because we don't have anything to track anything right now. It's like pieces of paper.
Yeah. And, you know, I talked to one guy for a few years, or I talked to one guy last year for a few times. He was at a large company. He was in charge of like improvement. And he basically said, he called me up, or he contacted me, and he said, you know, here's the problem. Accounting is sending us this information. We don't use it. We totally ignore it. But they keep sending it to us. It was like variance stuff. They keep sending it to us. And you know what? They never ask us a question about it. It was like,
I mean,
know.
I asked them questions about their incurred costs, but another problem is it's 2 weeks, like we close and then we do it. So what
Yeah.
can they do about it? Right.
Right.
So
Yeah. All right, so thanks for attending. I hope this was good for you. If you can think of any way I can improve this presentation, send me an email. I'm always looking to improve. By the way, let me ask you, did you like this format of today? 3 90-minute sessions? Because in the past, I used to do this like over my I used to do this maybe like Tuesday, Thursday, Tuesday, Thursday. So do you like this, or do you think doing it like over multiple days is better? Or it doesn't matter?
I think that, I mean, maybe get both options for certain folks, but to me, this is better, so I can just chunk it out.
Yeah, I thought getting it done in one day is easier too.
I think one
Okay.
day is easier for me.
Yeah. Plus, given the breaks, I stole this from the workshop I did for Central Coast Lean in California a couple weeks ago. This is the way we did it. I thought it was nice. Okay, I don't have any official survey, so again, that's why I just asked for ideas. I will send you a copy of the webinar presentation. I will send you a copy of the link to the recording of the webinar. The capacity, I forgot to tell you that, oh, I told you there's a template. I'll include the capacity templates in the follow-up email. And if you would like to have a follow-up one-on-one conversation with either you, or if you wanted to bring some other people in to just ask or talk about specific things, no formal training or anything like that. But if you wanted to get some people together, or if you start talking about this and they ask questions and you think I might be able to help you answer the questions, you know, we can get online for an hour and do this. Okay, that's sort of like an open-ended offer. Okay. Just contact me, say, hey, we have some things we would like to talk about, discuss, you know, be glad to do it.
Perfect.
And you know, if you want any formal help down the road in terms of either coaching or training or consulting on this or lean accounting, let me know. I'm available. Okay.
Thank you.
Okay.
All right.
thank you.
Well, you
What
guys
about-
have,
I
you
have-
have a good day, and maybe you can help each other out too. I'll send out the emails too. I have a list of everybody who attended and their email address. If you don't mind, I'll send it to you.
Yeah.
Okay.
Yep.
All
What
right.
about the pricing and quoting webinar? Were you gonna let us have a link to that recording?
Yes, I will send the I'll send the presentation. I'll send the link to the recording.
And then what about continuing education? Because I need that. Do you do a cert for CPE?
Yeah, I can do the CPE. Yeah, I need to, I'll give you, yeah, I'll get you the certification.
Okay.
Yeah. You attended the live. We had a lot of questions that you answered, and you did the exercises. If you know what would be really good for me, just for my record keeping, if you could send me your completed Excel spreadsheets.
Okay.
Okay, because if I ever get audited by NASBA, I'm not worried about it, but if they ever said, oh, we want to audit this class and we want to see that they answered all the questions because it's group internet, I need to have some documentation.
Okay.
All right, and that's true of any others that if you're CPAs, you want the CP, do the same thing. And I'll
Thank you.
send that in the follow-up email. All right, you guys have a good day. Hope to see you soon someplace.
Thank you.
Hey, guys.
All right.
All right,
Bye.
bye.